Bonjour à tous. Good morning, Mr. Brown. Alors, nous sommes prêts, à moins qu'il y ait des questions préliminaires, on serait prêt à poursuivre l'interrogatoire avec Maître David.
Oui, en fait, si vous me permettez, Monsieur le Président, on a été informé hier qu'il y avait des difficultés là, au niveau de la traduction parce que c'était peut-être pas assez fort le volume du témoignage du Dr. Brown. Donc, on a changé le setup, mais si c'est encore le cas, c'est pas impossible que j'intervienne pour lui dire de parler plus fort parce qu'on nous a avisé de difficultés hier.
Très bien. Merci.
Bonjour, Monsieur le Président. Bonjour à la formation. Good morning, Dr. Brown. Before I continue with the questions I had prepared, I want to go back to one of the issues that we discussed yesterday. And in particular, well, it's actually mentioned in your PowerPoint presentation, so perhaps if the clerk could put it on the screen, la présentation de Dr. Brown, Madame la greffière, la page 4. Merci. Just a second. Okay, so it's the last bullet that I just wanted to clarify because you state here that investors are not bearing stranding risk. And then you go on, investors expect to earn the authorized return and to recover all prudently invested capital. The regulatory compact implies that the regulatory framework will adapt if necessary, but uncertainty about how this will be achieved is a component of business risk. So, if I'm not mistaken, yesterday in your testimony, what you said in a nutshell was that the risk is not that the utilities would not recover the assets, but rather the risk lies in how the capital would be recovered. Did I understand correctly?
We can't hear you, Dr. Brown. Okay, I heard the yes was the answer. We'll try to fix the sound. Donc, il va changer d'appareil tout simplement. Là, on va régler le problème.
How is this?
Much better.
Okay. I will try to speak more loudly.
Okay, so I'll just repeat the question so that the stenographer can note your answer. My question was, and I want you to clarify if that's not the case. I understood from your testimony yesterday that you said that the risk regarding capital recovery is not so much that the utilities can't recover their assets. The risk is rather that in how the capital will be recovered. Is that correct?
Yes.
Okay, and can you explain to us a bit more what you mean by that? What do you mean by how the capital will be recovered? Are you saying that you see evidence that the regulatory compact could change, that the way the three utilities are regulated could change in the next few years?
I think at some point, perhaps in my testimony, or if not in testimony in an IR response, I gave an example of smart meters. So perhaps I can just talk briefly using that example. So various utilities in the recent past have decided that it would be beneficial to install smart meters with more functionality than the traditional meter. And often it happens that the process of installing those meters is more efficient if you install essentially all of them at the same time, rather than waiting for the traditional meters to break down sort of customer by customer. And therefore, if a utility proceeds to install the smart meters, it is likely that at least some of the traditional meters that are being replaced may not have been fully recovered. And therefore, there would be an outstanding undepreciated amount, which ordinarily would be recovered over time. But because the meters are being removed from service, if nothing else happens, that recovery would stop. And so a utility in that circumstance would typically need to come before the regulator to seek permission to replace the meters and to transfer the undepreciated balance of the traditional meters into some kind of account where it would then be sort of amortized over time. So the utility would be seeking to recover the outstanding amounts of the traditional meters, even though those meters are no longer in service. And so that would be an example of where some kind of regulatory action is required in order that prudent investments in this case, traditional meters can continue to be recovered. And so that's an example of the type of change that I'm talking about. It's not a change in the regulatory compact. The regulatory compact that underpins everything we're talking about is that investors have a reasonable opportunity to earn the fair return on prudently invested capital. It's just that in order to maintain that reasonable opportunity, the framework the regulator may need to take action of some kind. And it's that need to come before the regulator and to present a case and not necessarily knowing the outcome or what all else might happen, that is a source of uncertainty.
Okay, well, in fact, this very issue has already been tackled by the Régie de l'Énergie, because the electricity distributor a few years ago, about 4 or 5 years ago, did a massive switch to smart meters. And all of this went before the Régie. All of this was authorized by the Régie. And although to be honest, I hesitate to say this because I don't want to testify, but my understanding of that case is that all of the capital involved in this transition was recovered by Hydro-Québec. And so the history of the regulation at the Régie de l'Énergie doesn't really indicate that there would be any risk with respect to the gas utilities changing to smart meters. In any event, even if there was, could you explain to us in more detail how exactly investors would be prejudiced?
Well, perhaps I can just step back again and, if we think from the perspective of an investor in utilities, in utility assets, what is that investor doing when the investor makes an investment? They are purchasing assets which, in the case of a gas utility, are literally in the ground. Those assets have a very long economic life, and they have essentially no alternative use. If utility assets are not being used to provide utility service, there's really nothing else you can do with them except perhaps sell them for scrap or something. The alternative use is minimal, and so really that act of investing is in some sense quite risky, because you're making a very long-term commitment and you've got no option after you've made your commitments to do anything else but sit there. And so that the starting point is really one of some exposure from the investor perspective. And that's why we have this apparatus of utility regulation and rules about how utility regulation works, and the adherence to precedents and so on, to create the environment we have today in which utility investing is low risk. It's low risk, and therefore utilities can attract investments at low cost relative to other types of companies and other types of economic activity out in the market. And that's, of course, beneficial for customers. And that's why we should expect regulators to do what is necessary to maintain that low risk environment. And by and large, they do. But nonetheless, from an investor perspective, as I think I may have said yesterday, given the choice between a utility that can sort of continue operating as normal, not facing any new risks or any requirement to change its operations or its business plan, if that's one choice, and the other choice is a utility that needs to do things differently in the future and come before the regulator and ask for things and so on, the second utility has more uncertainty than the first, and therefore at the margin or in within a range such as the range that Dr. Valadson has from her sample, the second utility needs to be higher in that range than the first.
Okay. I mean, I understand your answer on a theoretical level, but I submit to you that the history of regulation before the Régie de l'énergie doesn't support your concerns, and that there is no generalized concern for the recovery of capital assets, and there is no general concern, if you look at the history of the regulation here, of stranded assets. But if you permit, I'd like to move away from theoretical discussions to more factual discussions, because the board has to make a decision based not just on theory, it has to make a decision based on facts. So I understand from the Avisio report that Avisio identified 5 business risks that are of particular relevance to the 3 Quebec utilities, and I summarize them once again. First is public and environmental policies. Second is composition of a customer base. That's the residential industrial balance, if you wish. Mm-hmm. The third is that the fact that the energy context in Quebec is different because here electricity is cheaper. Business size. Gas utilities here are relatively small compared to other North American gas utilities. And business partnerships. Now, is it the case that these 5 risks identified by Avisio, or at least most of them, have already existed for a long time in Quebec? These are not new. Is that correct?
I haven't studied the history of the Quebec utilities. I'm really making a point-in-time assessment and doing the best I can to compare the situation of the Quebec utilities with the situation of Dr. Vladson's sample. So I can't really comment on the extent to which things, well, I certainly can't comment in detail on the extent to which things have changed over time.
So you can't really comment on the evolution of risk of the Quebec utilities?
No.
Okay. Well, I'd like to, Madame Graffia, if you could put an exhibit on the screen, B131. Oh, sorry. So if you could turn to the bottom page, the second page, Madame Graffia. And I don't know if it's possible to make it bigger or to remove the left-hand margin. Est-ce que c'est possible d'enlever? Oui, exact. OK, c'est correct comme ça. Peut-être le monter un peu. Parfait. So this is a table that was prepared, I believe, at the request of the Régie. And what it does is that it compares the allowed and the achieved rate of return for Énergia, Intragas, and Gazifère. So on the left hand, you have Énergia, and then you have on the extreme left the authorized rate year to year. So we see in 2002 was 9.89, and then the most recent rate in 2021, 8.9. On the second column entitled taux, TAUX, that's the achieved rates. So you see in 2002 we have 10.67, and in 2021 we're at 9.40. So Madame Lagraffia, if you could move towards the right of that chart. The same exercise is done with Intragas. Although we don't seem to have the detail for the allowed rates year to year for Intragas. I'm not quite sure why, but it doesn't really matter. And if you go to the extreme right, you have Gazifère. And again, you have a left-hand column, the allowed rate, and the right-hand column is the achieved rate. Now, when I look at these numbers, I note that Énergia and Gazifère have always been at or above the allowed rate of return. So clearly, up till now, at least for the last 20 years, the 5 business risks that have been identified by Avisio have not affected the 3 companies' ability to earn a good return for their shareholders. Would you agree with me? Based on these facts.
Well, the numbers are the numbers. The achieved return is on average above the authorized return, and in almost all of the years, I think that is also true. This, though, is this is not the return that well, investors obviously care about the returns that they receive, and as I've said many times, fundamentally utility assets are long-lived, and so the investors won't have recovered their investment until 30 or 40 years. A history of we have a history of 20 years or so here. It's history. Investors need to look forward, and so what's relevant for an investor contemplating making an investment now is being able to recover invested capital over the next 30 or 40 years. And so the investor needs to needs to look to the future.
Okay, but when the REGI is setting a rate, how far forward does the REGI need to look? Is it being called upon to look 30 to 40 years ahead?
In assessing business risk, yes.
So it's not immediate risk that needs to be assessed in your view? Imminent risk?
Well, all elements of business risk, but fundamentally it's a long-term assessment because the assets are long-lived.
Right. Now, when I look at these results, what I surmise is that the rate of return seems to be impervious to all external elements, to all external variants, even those of a global or historical scale, because I see no impact on the rate of return related to the 2008 economic crisis, the global economic crisis. I see no impact on the rate of return related to the application of the carbon tax on the gas utilities in Quebec since 2015. I see no impact on the rate of return related to the pandemic, although maybe the 2021 numbers don't include all of the impact of the pandemic. So far, I see no impact. I see no impact related to weather variations. In other words, distinguishing very cold winters from very mild winters. I submit to you that very few companies have this kind of stability in their rate of return. Would you agree?
If you mean companies in the economy generally, then yes. If you mean utilities, I would expect very many of them to show stable returns over time.
And doesn't this generally point to very low business risk?
Again, relative to companies in the economy generally, yes, utilities have low business risk, but that's not really relevant to the present exercise because in order to meet the fair return standard, we have to compare, we have to set the REGI has to set the authorized rate of return relative to returns investors can get from other investments of similar risk. And so that means other investments of relatively low risk.
Okay. I'd like to now examine the issue of regulatory lag, because you state that this is one of the components of business risk. You also state that the U.S. sample, Dr. Billitson U.S. sample, has a similar regulatory lag to Énergir and Gazifère. Is that correct?
Yes, broadly speaking.
Okay, well, page 27, page 29, that's what you state. If a utility had no regulatory lag, none, how would their achieved rate of return compare with their allowed rate of return? Would they be the same or very close?
Yes.
And would that relationship show a lot of variation from year to year?
I would expect, with no regulatory lag, I would expect the achieved return to be close to the authorized return in each year.
Okay. And when developing your testimony, did you review the returns earned by the US sample?
No.
And why didn't you study this? You stated in your report that volatility in returns and regulatory lag are closely related, but you didn't look at this before concluding that the regulatory lag of the Quebec utilities and the US sample are similar?
No, for a couple of reasons. One straightforward one is that I don't have the data on achieved returns for the US sample, but even if I did, not sure that that's the best way to assess regulatory lag on a forward-looking basis, because there could be other things showing up in historical achieved returns. There could be things, factors influencing achieved returns in the past, which are just not relevant in the future. But in any event, I don't have the numbers, so that's not something I would have been able to do. What I did do is expend some effort in trying to understand what mechanisms are available to the sample utilities for rate-making purposes, and to understand on that basis, to try and understand whether changes in costs or new costs that appear over time, can those new costs be can they result in an adjustment to rates relatively quickly or not? And that's what I mean by regulatory lag. And so that's why I think we looked yesterday at a sort of at a summary of the mechanisms that are available. And many of the sample companies do have mechanisms to adjust rates without a full-blown rate case, and on that basis, I judged the regulatory lag to be relatively short, as it is in Quebec.
Okay, so you would agree that regulatory lag, there isn't much regulatory lag in Quebec.
That's my understanding.
Okay. On the issue of the share of gas being used in Quebec, the fact that there's less residential heating in Quebec done through natural gas as opposed to electricity. On pages 23 to 26 of your report, you compare the gas share of residential energy consumption in Quebec with those of the US sample. So my question is the share of residential energy use that comes from gas a component used in setting gas rates?
No.
And does the share of residential energy use feature in any formula for utility shareholder returns?
I'm not quite sure what you mean by formula for returns, but I'm happy to accept that regulators setting utility rates do not need to look at will not look at the share of natural gas in household energy consumption in any sort of formulaic way.
And isn't that also the case when a regulator is setting the rate of return?
I would be surprised if any of the US regulators, that I've been examining, would be interested in the share of natural gas in the household energy mix.
You would be surprised if they were interested, and would that be the case with Canadian regulators as well? Equally surprised?
I guess right now we're talking about the business risk of the Quebec utilities, and I wouldn't. The reason that I have put some statistics about the share of natural gas in household energy use in
a causal connection between this variable, in other words, the share of residential heating done by gas, and the volatility and shareholder returns.
Those two things are not connected, as far as I know.
Not connected. Okay. And does your
Maître Hamelin, on vous a vu pendant 1 seconde et vous êtes disparu.
Me voici. Mais je ne vois pas, peut-être parce que c'est... Ah, OK.
En fait, c'est moi qui... Moi, je ne vous vois pas, Maître Hamelin. Je vous ai, j'ai encore une pastille. Là.
Pourtant, ma caméra est ouverte. Est-ce que vous me voyez?
Non. Mais peut-être, normalement, moi, ce que je fais, c'est que je déconnecte et je reconnecte, puis ça règle normalement le problème.
Bon, alors, je vous reviens. Est-ce qu'on me voit maintenant?
Très bien.
Oui.
Alors, so, Mr. Brown, during the pause, I understand that you had the opportunity of looking at the information that we provided to you with respect to the Plan de Résilience or Resilience report, which is essentially a chart pertaining to the competitive position for a period 2020 to 2050 that was prepared by Énergir. My understanding is that prior to the recess, you didn't have the chance to look at this document. Now that you have had the opportunity of looking at it, would you agree with me that this is useful and relevant information to assess demand or competition risk for Énergir?
Well, not really, because this is a relative assessment that we're undertaking. And so we need to understand the risk of Énergir relative to something else, a benchmark. And this report is just about Énergir.
Okay, but am I correct? Because we can go back to the description of your mandate, but I think that based on, and we can go back to your report, but my understanding is that your mandate is assessing business risk and in particular compare it to other comparable utilities. Is that correct?
Yes.
So to compare, you have to priorly assess the business risk of the various utilities, correct?
Yes.
So I then restate my question. Would you believe, to determine business risk for Énergir, that this information on competitive position between electricity and natural gas is irrelevant information to assess business risk of Énergir?
It's relevant, but it doesn't tell us anything about the position of Énergir relative to the sample.
But that would be the second step of your analysis, correct?
Yes, and that's why I looked at the cost and emissions associated with electricity in other parts of North America. And if one were to prepare a chart like this for gas utilities anywhere else in North America, it would look very different. The dotted line would be between a halfway down and much further down the columns. And so this chart shows my understanding that for Énergir's customers, in terms of the fuel bill, gas is somewhat cheaper or about the same as electricity. If you were to do the same analysis for other utilities, you would see that gas is far cheaper than electricity, because electricity is much more expensive.
But just at the basis, because if we go back to your analogy with cards, you indicated yesterday that it's like having a set of cards. You need to look what is in your hand and then compare it. But at the beginning, you need to know what's in your hands, right? So the comment I'm making is that this isn't relevant information to assess Énergir's only business risk, correct?
Yes, the position of gas relative to electricity and the competition between the two, yes, absolutely, that's relevant.
I would like now to turn to your report, page 22. And it's on the same topic, and it's to follow some of the questions of Maître David. Question 34, we see the question, does the natural gas distributed by Énergir compete with electricity? The answer given, sorry. Oh, sorry, 22 of the document, but I was referring to the question 34, so that to be clear, sorry.
Yes, that's fine.
Okay, perfect. So the answer was, particularly in the households, electricity is viable alternative to natural gas for customers in Énergir's service territory. And then you continue with table 4, which is at page 23, relating to residential customers' annual growth rate. My question to you is, am I to understand that this comparison with growth rate has been done with respect to residential customers only?
That's correct.
And you have not done any analysis with respect to the same type of analysis with respect to the other segments of Énergir's clients, for instance, institutional, commercial, industrial, correct?
That's correct.
I would like now to turn to the question of the of your sample, and I want to also make some follow-up questions on the on this aspect. And let's start with your footnote in your report. Your footnote 3 of your report. At page 2. So you indicate that I have not compared the utilities to the other samples described by Dr. Willitson because the gas LDC sample is the closest in terms of business operations. I insist on business operations for the purpose of my questions. While the Canadian sample contains some gas distribution utilities, it also I won't say the word, see the word papers to BV6. If we look at the US sample, is it fair to say that some of the utilities are not pure play distribution companies as well?
I'm not sure about that. I think they are. The sample as a whole is pretty clean. That's my understanding.
Okay, let's take the list of the utilities from Dr. Willitson's report. I took this one. It's at page 59 of her report. So I'll let you the opportunity of reviewing them, and then again, my first question is, can you identify, or is it possible that some of those companies will not be 100% pure play distribution?
Sorry, I'm just finding the right page.
59 of Dr. Willitson's report.
Est-ce que vous avez la cote régie, s'il vous plaît?
La cote régie, c'est... alors, j'ai juste la cote énergie, EGI1. Est-ce que quelqu'un peut me donner la cote régie?
B0015.
Merci. Mais oui, j'aurais dû m'en souvenir. Merci. So, Dr. Brown, are you 100% sure that all of those companies are all pure play distribution companies?
If the question is, do any of the sample companies have some operations that are not natural gas distribution, then I'm sure that some of them do. However, the large majority of the activities of the natural gas distribution sample is natural gas distribution. And I think Dr. Willitson has explained that in her report.
Let me suggest, and maybe you can take an undertaking, but I'll give you some information and you'll tell me if it's to your knowledge, and if not, then you can probably verify. If we take, for instance, Chesapeake Utilities, would you agree with me that only 30% of the assets... Sorry, just a second. I think it's 51%. Well, is it to your knowledge that Chesapeake Utilities have a percentage of its assets that is not regulated distribution business?
Well, we look at the table on the page you pointed me to. So this is page, well, it's figure 20 of Dr. Willitson's testimony. Chesapeake Utilities is listed as, the code in column 2 is R, and that means I think it's 80%. More 80% or more of the assets are regulated.
But do you know the percentage with respect to distribution?
In my understanding, Chesapeake Utilities has both a natural gas distribution utility, or possibly more than one, and electricity distribution. In my experience, the business risk of electricity distribution and natural gas distribution is very similar. And more precisely, the business risk of electricity distribution and natural gas distribution is much more similar than would be the case between, for example, natural gas distribution and natural gas pipelines, or even more so, oil pipelines.
Just to go back to the beginning of your answer, when you say that when you're looking at Chesapeake Utilities, you see R and regulated, am I to understand that you took the information from Dr. Willitson, and well, have you done your own independent analysis with respect to each of these utilities, or you take them as granted, or without doing additional verification on each of them?
This is Dr. Vladson's sample. Dr. Vladson selected the sample. As part of my work, I reviewed the business risks of the utilities in the sample, and one of the sources of information on which I relied is the annual reports filed by each of the 9 sample companies. I reviewed those reports because those reports contain an identification of significant business risks as identified by the management of those companies. And so I have reviewed those reports, and therefore I am at least somewhat familiar with the operations of those companies as described in their annual reports.
Okay. So with respect to Chesapeake Utilities, you indicated that they may have natural gas and electricity. But my question, would you know the correct percentage of the distribution portion of the company?
If your question is natural gas distribution versus electricity distribution, off the top of my head, I certainly don't. I would expect to find that information in the annual report.
Okay. So as an undertaking, I will ask you to provide the information as to the percentage of gas distribution business in the for this utility. Is it clear, my Dr. Brown, my question, my undertaking for you?
The percentage of what?
Of a gas distribution business in Chesapeake Utilities.
I suppose that there are a number of different metrics that one could use to assess the relative contribution of one business to the company as a whole. But I'm sure I can find at least one relevant metric.
Thank you. Monsieur le sténographe, est-ce que je dois répéter l'engagement ou ça va?
Non, ça va bien.
D'accord.
Ce sera l'engagement numéro 3.
What about New Jersey Resources? Are they 100% distribution?
No. As you can see in the table, this one is mostly regulated, which means more than 50%, but less than 80%, I think.
If I was going to say probably 2/3 of its assets are in distribution and the remainder in other activities, would that be a fair description of this utility?
That would be consistent with figure 20 in Dr. Vladson's testimony.
Okay. What about Southwest Gas? Is it to your knowledge that half of this utilities revenue came from other operations than distribution? Other type of operations?
Well, again, looking at figure 20, Southwest Gas is listed as being more than 80% regulated. So, in my understanding, Southwest Gas is entirely or almost entirely a natural gas distribution business.
Do you know if some of the utilities are also pipelines, transmission utilities?
Some of the utilities in the gas distribution sample.
Yes, would that be possible?
Not to any significant extent, would be my understanding.
But that would be possible?
They may have some assets in those activities, but not to any great extent, would be my understanding.
Okay. And just to go back to the answer that you gave previously with respect to gas versus electricity in terms of business risk, am I to understand that your position that is that with respect to business risk, in this case, electricity and electricity utility would be a comparable distributor to assess business risk?
Well, firstly, just to be precise, I'm talking about the activity of distributing electricity relative to distributing natural gas. Where in this case we need a benchmark, and to the extent that I wouldn't start by looking at electricity distribution utilities as a benchmark for natural gas distribution. I would start by looking at natural gas distribution. But in doing that, if it happens that a sample company has oil pipelines as well as natural gas distribution, that would be concerning, because oil pipelines and natural gas distribution do not have the same business risk, or not even similar. If it happens that a natural gas distribution utility is in the same corporate group as an electricity distribution utility, I would be much less concerned, because the business risks of those two activities are similar.
I will now turn to the Canadian sample. It's at page 53 of Dr. Velitsin's testimony. I understand from your testimony yesterday that you indicated that TC Energy was very different, because that it was essentially pipelines. Did I understood you correctly?
Yes, I haven't studied TC Energy in any great detail, but I'm not aware of any natural gas distribution business in that company.
Okay. Would you agree with me that Enbridge is an oil transmission company?
Enbridge does have significant oil liquids pipelines operations. That's my understanding.
And therefore, in terms of business risk assessment, it would be very difficult to compare.
It would not be my first choice of benchmark, no. If I had something else available that was a better benchmark.
Okay. Turning to Algonquin Power, do you agree with me that it's a power generator utility? It has no gas?
To be perfectly honest, I know nothing about Algonquin Power, but I see its name. So I assume that it has something to do with electricity generation.
But am I correct to in understanding that in order for you to determine that the US sample should be used instead of the Canadian sample of Dr. Velitsin, that you should have had the opportunity of reviewing each of the utilities to make this decision, this judgment between the two sets of samples, correct?
Yes, and I think if I go back to the footnote in my testimony that you began this line of questioning with, I explain that the Canadian sample is rather heterogeneous, and then I cite the evidence on which I'm relying for that statement.
Okay, but if I understand from your earlier testimony, you have not necessarily verified yourself, for instance, Algonquin power.
I'm sorry if I spoke too quickly. I don't remember what the business activities of Algonquin Power are, but I looked at them for the purposes of making the statement in footnote 3. So if you take me to the source material cited in footnote 3, I would expect to find the business activities of the Canadian sample laid out.
But did you have you done an independent analysis of the business risk other than Dr. Villadsen's report? Well, not sorry, an independent analysis of the correct samples to be that would be relevant to make a business risk assessment, or you simply used Dr. Villadsen's report?
I did not independently calculate or research which sectors the companies in Dr. Villadsen's Canadian sample are active in. I looked at the information about that contained in the work papers to Dr. Villadsen's testimony, and relying on that information, I made the statement in footnote 3.
Okay, so my understanding is that you looked and read what Dr. Villadsen has written, and you have decided to rely on that to determine that the U.S. sample was more appropriate. Would that be a good summary of the methodology?
Dr. Villadsen's testimony contains facts about which sectors each of the samples is active in and in what proportions. Based on those facts, I state that the natural gas distribution sample is a better benchmark than the Canadian utilities sample for present purposes.
So I understand from that you have not conducted an independent analysis to determine samples. You relied on Dr. Villadsen's factual information in her report, correct?
Yes.
Would you agree with me that there was nothing preventing you to determine your own sample?
Well, we had a division of responsibility. Dr. Villadsen, as I'm sure she will explain, is responsible for estimating the cost of capital using a number of different samples. Most of the utilities, if it was simply a matter of selecting a utility that's a reasonable benchmark in terms of business risk for the Quebec utilities, there are very many utilities one might choose from. However, almost all of those utilities would not be suitable for estimating the cost of capital for reasons that I'm sure Dr. Villadsen can explain.
let's stick for now to your mandate and your role, which is assessing business risk. So my question to you, in assessing business risk, and in order to then compare it to a comparable distributor, there was nothing preventing you to determine your own sample, correct?
No. Dr. Viladsen estimated the cost of capital for a number of different samples. I was in a position, therefore, to choose amongst the samples for which she has cost of capital estimates.
Not sure I understand your question, your answer. Let me rephrase it. You could have decided to retain other Canadian gas distribution companies as comparables, correct? Other than what Dr. Viladsen has put in her report.
I don't think so. I don't believe that there are any other Canadian distribution utilities for which cost of capital estimates can be made.
I'm not talking about I'm not talking about capital markets for now. I'm talking about comparable distributors to assess business risk. So have you done this independent analysis?
Well, I don't want to be at cross purposes here. The present exercise is to determine the authorized rate of return for the Quebec utilities using as a benchmark the estimated cost of capital for some other utilities for which an estimate can be made. And relating the one to the other is the business risk analysis that I have done. There would be no point in analyzing the business risk of a comparison utility for which the cost of capital cannot be estimated, because then where does that analysis go? It's got nowhere to go.
So in your view, there is no point in trying to determine the business risk for utilities such as Enbridge Gas, Fortis BC, ATCO Gas? Is that what I'm hearing?
Well, those utilities, I believe, are in Dr. Viladsen's Canadian sample, aren't they?
No, they aren't.
May
Dr. Viladsen as Fortis Inc., as Enbridge Inc., does not have Enbridge Gas, Fortis BC, nor ATCO Gas. So what I'm asking you is, for those, first of all, do you know those gas companies?
Some better than others, but I know what they are, yes.
Okay. My understanding is that you haven't verified if, for instance, those utilities could be considered as a comparable distributor in determining business risk. Because again, business risk, as determined in your report at the beginning, relates to operations and business environment of a company.
Well, actually, I did consider those utilities because they are in Dr. Viladsen's Canadian sample, and I have said that that sample is not a useful benchmark because it's too heterogeneous. Okay,
can you show me where Enbridge Gas is in Dr. Viladsen's sample?
Well, isn't Enbridge Gas a subsidiary of Enbridge?
Yes, but now you are considering, is it a fair assessment that Enbridge Inc. is the holding company, and now we're comparing the holding company with Énergir Associés? Is that what you're suggesting?
Perhaps, if I may, let me step back and describe my understanding of how the business risk and the cost of capital analysis relate to one another. The cost of capital analysis takes as its inputs financial information about publicly traded companies, that is to say, holding companies. Those holding companies own one or more operating subsidiaries. In the case of the natural gas distribution sample, there are 9 holding companies, which I think between them own 24 or more natural gas utilities, which I have analyzed in my report. The Canadian sample, I forget how many holding companies it has in it, but each of those holding companies owns one or more operating companies. Some of them are natural gas distribution utilities, others are oil pipelines or power generators or other things. So when the cost of capital estimates are estimates relating to the sample of holding companies, the business risk analysis therefore has to compare the business risk of the Quebec utilities with the business risk of the samples as a whole. In the case of the natural gas sample, the natural gas distribution sample, that's a reasonable thing to do because the natural gas distribution sample is reasonably pure play. All or almost all of its assets are regulated utilities, and the large majority are natural gas distribution, and there aren't any oil pipelines or other things in there. The Canadian utilities, the Canadian holding companies are less useful as a benchmark because although they contain natural gas distribution utilities, they also contain many other things, which are not good benchmarks for the Quebec utilities. And therefore, I determined that it is better to use the natural gas distribution sample as a benchmark. And I did not undertake any further analysis of the Canadian sample.
Give me just a second. Thank you, Mr. Brown. I have no further questions.
Thank you.
Merci, Maître Hamelin. Est-ce qu'il y aurait une question de la part de Maître Cadrin de la HQARQ? Ah, excusez, non, il reste c'est plutôt Maître Turmel de la FCEI.
Oui, bonjour, Monsieur le Président. André Turmel de la FCEI. Oui, nous avons quelques questions. Alors, je demanderai à Mme la greffière de mettre à l'écran la pièce B0204. We will work, Dr. Brandt, with evidence B0204. That is answer to the Canadian Federation of Independent Businesses à la question-réponse 2.9, si on veut mettre à l'écran. OK, nous y sommes. So good morning, Dr. Brown. Do you see the question answer on the?
I have it. Yes.
Okay, perfect. So on question 2.9, question is there in French. I'm just going to restate it in English. So you were asked, can you confirm that if a potential client finally choose not to connect itself to natural gas, he does not add any risk with respect to capital recovery? And so you answered the following. You said not confirm. Dr. Brown considered that if one of the utilities were to stop growing entirely, that this could be a signal of increased business risk, particularly if at the same time some existing customers are leaving the system. Dr. Brown's understand that this is not that it is not the case for the utilities currently. So my first couple of questions on that, sir, is am I right to say that your answer take as an assumption that the stop of growth is the result of market strength, as a general comment?
I don't think it matters why a utility stops growing. If it stops growing, I would think that would be concerning for the utility and its investors.
In fact, that if growth stops and that clients would leave, this would signal a decrease in the interest of natural gas? Can we say that?
Yes, that would be consistent.
Okay. But I think if maybe the question, the way it was asked, I think what we want to, we should have read otherwise. So the question, if the slowdown of growth is the result of choice made by, let's say, the utility or the regulator in itself, does that impact the risk of capital recovery in itself?
Well, a utility assets, as we've talked about, are long-lived, and so the investments that are being made now in the utility system are going to be recovered from existing customers and from future customers. The more new additional customers there are in the future, then the more positive the environment and the easier it will be to recover the cost of those assets, which are shared. I mean, the use of the assets is shared over all the customers. That will be easier in the future than if the number of customers is going down.
Okay. And on the risk of capital recovery in itself, am I right to see that this risk is directly linked to the fact that there is capital to recover?
Yes, if there was no capital to recover, then yep, then there would be no risk.
Yeah, that was my following question, and you exactly fit in. Thank you very much. And as a consequence, all things being equal, how less capital invested to connect clients could add more risk?
I'm sorry, could you repeat that question, please?
Yeah, thank you. Yes. So as a consequence of this, the discussion we're having, all things being equal, this is the usual sentence that has to be said. How less capital invested or investment to connect clients could add more risk?
Well, because the total capital invested in the utility consists of, it's a portfolio of, or the utility has many assets, some that were recently constructed and some that were constructed longer ago. But the the recovery of the rate base as a whole, that has to come from, as I said, existing customers and new customers in the future over time. So if a utility stops growing, yes, that means no more connection assets are being added to the rate base, and therefore no more connection assets need to be recovered in future. But the existing rate base is what investors are worrying about. They don't, if there's no investment, there's no additional investors, but the existing rate base still needs to be recovered. And that existing rate base, as I said, has to be recovered from current and future customers. And that's more difficult if there are fewer customers.
Yeah, thank you. Madame Greffière, si on va aller à la question-réponse 1.5, we will go to the question-answer 1.5 in the same document. 1.5, 1.5. So on question and answer 1.5, we see question in French. I'm just going to restate it in English. So on the profitability criteria, you were asked if a more demanding profitability criteria, meaning requesting more profitability to get another rise investment, can reduce the risk of capital recovery. And then you offered the following answer, mentioning that you were not aware of any circumstances in which profitability criteria would be relevant for capital recovery risk. Dr. Brown understanding is that the standard for whether investment in asset used to provide utility service can be recovered in rates is prudence, which has nothing to do with profitability criteria. So end of answer. So let's use an example maybe to help us to understand. For instance, if the Régie de l'énergie, the regulator you're facing today, would decide to add a more, let's say, restrictive policy on new clients, let's say that they would ask that all new clients would have to pay for the totality of connecting cost. Would that reduce the risk of capital recovery?
Just to make sure I'm understanding the question.
Yeah.
When a customer connects to the system, after connecting, they will pay rates the same as any other customer, I suppose. So your question is, when they connect, if instead of the connection assets being added to rate base, the connection assets are completely paid for by the customer. Is that your question?
Well, no, I think I'm going to restate my question maybe to be sure we are on the same page. So let's say that it's an example. Just want to understand if the regulator, this regulator, would decide to decide and add a more restrictive policy than today for new clients. Let's say that they would decide to say all new clients will have to pay for the totality of connected costs. So we're looking forward. Would that reduce the risk of capital recovery in that action?
Well, I'm a bit worried that I don't have the same hypothetical in mind as perhaps you do. So let's say the status quo is that customers connect, the connection assets go into rate base, and the customers pay rates the same. The new customers pay rates the same as the old customers. But that's the status quo. And then the hypothetical is that the new customers, in addition to paying rates, also pay for their connection assets so that no connection assets go into rate base. Then there is less capital to be recovered in future, I suppose. And in that sense,
less risk.
There is less risk.
Yeah,
I suppose.
Okay. And that fits with my last question on that. So I don't know if you were there yesterday. One of Énergir testimony yesterday was given by Mr. Tremblay, and he was following on Mr. on Energer CEO, Mr. Lachance, on Monday, when they testified, but it was in more detail yesterday, that Energer was thinking about, for some clients, to reduce from 40 years to 20 years the duration of profitability analysis, meaning the period over which the profitability is assessed. Have you heard about that, or it was said yesterday?
Not before yesterday, and I will confess that I could not follow that discussion. I'm sorry to say that this topic of profitability index is not something I'm familiar with, and I don't really understand what that calculation is, how it's done, or what it's for, I'm afraid.
No offense, but it was said nevertheless in the testimony yesterday. So, and my question that refers to that, that's a facts that we learned yesterday that could be filed at the board later on this year or next year. We'll see. It's not clear yet. But do you agree that if we ask to a client to be more profitable on a 20 years period rather than 40 years, that the utility will connect less clients and there will be less investment?
Well, again, I am worried that I don't understand, and therefore what I think this means is not what it actually means. So let me state what I think it means. I think this means that, or the context, I think, is that when a customer asks to connect, that requires some investment by Energer in connection assets, which will go into the rate base. And there is some threshold amount on a per customer basis. And if it's more expensive than the threshold, then either the customer is not allowed to connect, or the customer has to pay for some of the assets itself upfront, so that after that payment, the net amount is below the threshold. Is that correct?
I think it is correct, but some other people in my team may correct me. but the fact is, let's say that, and I think from yesterday's testimony, and the Energy will correct that later on if they want, but say they could decide for that. Let's say that the client that want to remain using natural gas, fossil natural gas, will connect with the profitability criteria will be. I hope I'm right here, will be on a shorter period of 20 years when a client that would elect or decide to use renewable natural gas, the asset will be recovered over 40 years. So, and that's a real possibility, I think, that may happen. So in that example, or the fact that we connect, that Energy will connect probably less clients, that means that there probably will be less investment. So we think, well, I think so. I want to confirm with you if my assumption is okay or not. And if you can answer, that's fine. If not, it's okay also.
Well, perhaps let me answer it in a way that I think is correct. So I think this proposal means, or the effect of this proposal is that some customers can't connect unless they choose renewable natural gas. And I think the effect of that is to reduce growth relative to, well, no, I don't even want to say that actually. No, I think I need to go a step further back. This change, it seems to me, is part of Energia's response to the environment in which it is operating. There are a number of challenges to do with, you can call it the energy transition. We've talked about competition between electricity and gas. We've talked about the public policy initiatives to reduce emissions from the natural gas sector. It seems to me, even though I don't understand really exactly what this proposal is, that it is part of Energia's response to the environment in which it is operating. And so in the context of the work I have done and the business risk analysis, the fact that Energia is responding in this way is a symptom of the fact that the business risk environment of Energia is not the same as the business risk environment of other natural gas distribution utilities.
Okay. So maybe, and last line of question, Madame la greffière, si vous voulez aller dans la présentation de Dr. Brown, we would go back now using your presentation, sir, on the page 4. Et ce sera ma dernière question, Monsieur le Président, ou mes dernières questions sur ce point.
Maître Turmel, c'est la pièce B027 à la page 4 du PDF?
Oui, c'est ça. Vous avez, merci, Madame Maître Duquette.
Maître Turmel, est-ce que c'est...
Oh non, c'est la présentation PowerPoint, pardon. C'est la... Okay. Excusez-moi.
Donc, la pièce 0344.
Your PowerPoint presentation, Dr. Toby, from yesterday.
Mm-hmm.
We'll just wait for the... Yeah, okay, it's coming. Okay, page 4. Okay, last item. And that also refers to one of my colleague, Maître David, question to you, where you said, so in reference to page 4, last bullet, where you said to Maître David that the perception of risk by investors was not that capital would not be recovered, but how it would be recovered. And you also said that investors would perceive less risk in utilities that do not face that prospect or modification in how the capital would be recovered. Is this correct? Did we capture the your statement right, Doctor?
Yes, I think so.
Okay, perfect. My also question on that is: do you have any evidence that support that statement? I understand it's an opinion, but is that? Can you direct us to some piece of evidence that support that assertion? Or it's only an opinion form from your own experience? Just want to understand where it comes from.
It's an opinion about how to apply the fair return standard in the context of comparing one utility with another. Of course, Yeah, I'll stop there. It's an opinion.
OK, thank you. Ça termine les questions, Monsieur le Président. Je vous remercie.
Merci. Alors, question de la régie, pas de question de la régie. Madame Falardeau, Duquette. So I just have a few short questions to Dr. Brown about his background. You mentioned yesterday in your introduction remarks that you presented testimonies before the Alberta Utilities Commission. I see in your bio that this was in 2020 in proceeding. Was it, my question is just, was it a similar case as we're having today in to set the rate of return for gas distribution?
The proceeding listed, I think the one that's listed in my resume is a different proceeding, which was actually more of a rate case proceeding. The evidence I submitted in a rate of return proceeding was in February of this year. So it's in my resume now, but it wasn't when I filed, when my resume was filed last year. The proceeding from February of this year is what in Alberta is called the generic cost of capital proceeding. It's a proceeding to set the authorized rate of return for all of the gas and electricity distribution utilities in Quebec, in Alberta. And on previous occasions, I have worked on the dockets, the generic cost of capital docket in 2 or 3 times in Alberta, although in those prior occasions I wasn't the witness.
Okay, and in this last proceeding, was it the same approach that we're having today, where you had to work from a third-party report like Avisio, or was it your own presentation?
It was my own presentation, although I would emphasize that the proceeding in February of this year was a little bit unusual, and it had a sort of a complicated history tied up with the COVID-19 pandemic and so on. It was really, it was something of an abbreviated proceeding. And I think the conclusion of it was to sort of hold over the authorized return from the time before, as it were. But in any event, there was nothing equivalent to the Avisio reports. Although I would say that I consider myself quite familiar with the operations of the Alberta utilities from my work in other proceedings in that jurisdiction. Which is not the case in Quebec.
Could you just repeat the last?
I'm sorry. Yes, I would say that I'm much more familiar with Alberta regulatory environments than I am with Quebec, because before the last time I worked I haven't worked in Quebec for maybe 10 years, the last 10 years.
Perfect, thank you. Alors, ça conclut les questions au Dr. Brown. Thank you, Dr. Brown.
J'ai peut-être, si vous me permettez, Monsieur le Président, j'ai peut-être quelques questions de réinterrogatoire, mais pour ce faire, je vous demanderai quelques minutes, mais I'm going to say this in English. I'll ask Dr. Brown to leave the room where we're in because we want to have a discussion and I don't want to influence his answers. If I have questions in redirect, so if I could have a few minutes, he will leave the room, we'll have a discussion, and we'll get back to you maybe 5 minutes. Ça va?
Alors, on peut suspendre pour 5 minutes.
Parfait. Merci. Alors, vous m'entendez?
Oui, nous vous écoutons, Maître Ouellet.
Parfait. Donc, nous n'avons plus de questions nous n'avons pas de questions pour le Dr. Brown. So we have no further questions for Dr. Brown. I think Maître Georgescu Maître Georgescu voulait mentionner quelque chose là, avant de passer au prochain témoin, donc je lui cède la parole.
Oui, d'accord.
Thank you, Dr. Brown. Bonjour, Monsieur le Président. Bonjour à la formation. Monsieur le Président, c'était simplement pour vous aviser que l'engagement qui a été pris par Avisio lors du témoignage de Monsieur Lessard a été déposé sur le SDE. La réponse à l'engagement a été déposée sur le SDE ce matin. Donc, il est accessible si la Régie souhaite la consulter. Alors, c'était tout ce que j'avais à vous dire aujourd'hui.
Parfait. Voilà. On l'avait noté. Est-ce que la HQARQ a pris connaissance de la réponse? Et est-ce que vous auriez des questions sur l'engagement qui a été déposé?
Oui, bonjour, Monsieur le Président. Oui, nous en avons pris connaissance et nous n'avons pas de questions à poser. Ça répond à ce qu'on pensait.
Parfait, merci beaucoup. Puis pour l'engagement numéro 2, est-ce que vous croyez être en mesure de le déposer aujourd'hui?
Juste un petit instant, nous allons juste revérifier l'engagement numéro 2.
Donc, je ne sais pas si vous avez entendu, malgré les micros fermés, mais on nous informe que ça devrait être prêt en début d'après-midi.
Parfait, merci beaucoup.
Alors, Monsieur le Président, on est à votre disposition. Si jamais vous vouliez commencer avec le Dr. Villadsen, mais avant le lunch, nous, on peut commencer le début. Il y a quelques petites questions introductives. On est à votre disposition. On peut arrêter maintenant aussi, c'est comme vous voulez.
On peut commencer, allez-y.
Parfait.
Est-ce qu'il serait possible, Monsieur le Président, de libérer le Dr. Brown?
Oui, certainement.
Donc, on va prendre quelques petites secondes pour s'organiser et puis on va commencer.
Oui, vous pourriez nous indiquer aussi pour l'engagement numéro 3 quand vous prévoyez y répondre.
Je vais consulter le Dr. Brown.
Très bien, merci.
Donc, demain matin, on devrait avoir la réponse.
C'est bien noté, merci.
Alors, est-ce que tout le monde a la présentation de la Dr. Villadsen qui a été déposée sur le système? Je crois que c'est EGI 28, si je ne m'abuse.
La code de la régie est B350.
Ah, très bien. Exactement. So, good morning, Dr. Villadsen.
Good morning. Can you hear me?
Yes. Perfect. We're going to put on the screen the PowerPoint presentation that you prepared. So I think you're familiar with what is going to be shown on the screen. So do you adopt this as being part of your evidence?
Il faudrait
I do.
Docteur.
Vous avez raison, je m'excuse, un petit peu trop pressé. So you will be sworn in before I start asking my questions, obviously.
Dr. Villadsen,
Do you solemnly declare that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth?
I do.
Please give us your name, occupation, profession, and as well as your business address.
My name is Bente Vilatsen. I'm a principal at the Brattle Group, and my address is 1 Beacon Street, Boston, Massachusetts, in the US.
Thank you very much.
So I'll restate my earlier question. You have on the screen in front of you a PowerPoint presentation. Do you recognize the document?
I do.
Can you briefly explain what this document is?
This document is a presentation of my direct evidence in brief.
Do you adopt this as being part of your evidence?
I do.
So we see, you can start briefly with the agenda that we see on the second slide.
Yeah, if we could move down a little bit so we can see the agenda. And what I was going to talk about here is my background and what information I relied upon to come up with my recommendations. I will discuss a few key concepts that's very important for cost of capital determination. And I'll provide a brief summary of my recommendation before I move into some key issues that are of interest here, namely inputs to the various models we use, interest rates, the market risk premium, systematic risk or beta, and then the input to the discounted cash flow model, which is growth rates. I'll talk about capital structure, and I've already seen some questions about that I'll try to address. And lastly, I'll review some of my ROE recommendations and capital structure recommendations and how I arrived at those.
What is it that you mean by key issues? You have 5 key issues there. What are those generally?
Those are key issues that really determines what cost of equity we come up with. And it's also issues that are somewhat controversial in this proceeding, issues where we are all in agreement I didn't want to address specifically.
Okay, so those 5 issues would be disagreement with whom?
With Dr. Booth, who's the other witness in this proceeding.
Okay. Maybe we can move to the next slide on background, and you can brief us on your background and mandate.
So my background is I have 22 years of experience, primarily in cost of capital and regulatory finance. I focus on cost of capital, regulatory accounting, and utility mergers and acquisitions. That's the bulk of my work. I have worked extensively in Canada. I've been a consultant to the British Columbia Utilities Commission. I've been served as an expert for the Ontario Energy Board, and I've served as an expert for utilities in Alberta, as well as an expert in pipeline arbitrations. I've also done extensive consulting work for Canadian pipelines, electric utilities, and gas utilities in 5 different provinces. And lastly, I have cost of capital experience in both Canada, the US, as well as outside, like Mexico, Barbados, Australia, and in Europe.
What kind of experience do you have outside of Canada, just briefly?
So I've served as cost of capital in US cost of capital proceedings, in Mexico's cost of capital proceedings, as well as in Barbados, Australia, and Europe. I provided other expert reports and in some cases appeared at hearings.
Okay. Maybe you can go on with your mandate.
And in terms of my mandate, I was asked to provide a recommendation for the cost of equity and equity percentage for the regulated Quebec gas utilities, that is Énergir and Gasifer, until a new rate case, and in the case of Intragas, for the next 10 years. And jointly, I'll refer to those as the utilities. It's all the gas utilities here in Quebec. So that was my mandate. Okay. And if we could scroll down to the information I relied upon. In terms of the information I relied upon, from the utilities, I got a number of financial data, and I used that primarily for my credit metrics analysis. They also provided me with credit ratings reports, as well as a list of prior cost of capital proceedings here in Alberta. And I looked extensively at data providers, and I listed those here in my second bullet point. I don't think I need to mention all of them, but these are all well-recognized data sources that I use to come up with my estimates.
If you just excuse me for a second, you said that you were provided by the utilities with a list of prior cost of capital proceedings here in Alberta. Was that what you meant?
Here in Quebec.
Okay.
My apologies.
Go on, sorry.
And I also looked at various public data that's simply available on the internet. That includes documents from the WSG, as well as from other regulators, the Bank of Canada, Federal Reserve, and other public sources. Also credit ratings reports and articles in the news. And lastly, I would mention the testimony of Dr. Brown, who assesses the risk of the utilities relative to my US gas sample. So that was an input to my analysis. So if we could move down to my cost of capital recommendations, I just want to summarize them before we get into all the details of how we got there. So my summary is that I recommend a benchmark return on equity of 10% and on 43% equity, common equity.
Now, Dr. Vlatin, if you'd allow me, I see here on this slide that you have no preferred shares. Maybe can you discuss that in a bit more details, why you have no preferred shares, where we know that Énergir presently have 7.5% of preferred shares?
So Énergir currently has 7.5% deemed preferred shares. They don't have any actual preferred shares. So it's a little odd to have preferred shares in a capital structure when there are no preferred shares and cannot be any preferred shares because they don't actually issue equity or preferred shares on their own. So the question we asked ourselves, or I asked myself, is what would be reasonable for these utilities? Assume we start from scratch. So we need to have a capital structure that is reasonable, and we also need to have a capital structure that leads to a reasonable, fair return in combination with the allowed return on equity. I heard yesterday some discussions of an optimal capital structure. In my opinion, there is no such things. There's good capital structures and there are bad capital structures. And I'll explain what I mean by that. A good capital structure is one that allows you to have solid credit metrics and allows you to take advantage of the tax benefits of debt. That puts you somewhere in the middle of the range. You can't have 100% equity. You can't have 100% debt. So you need to put it in the middle. Within that range, you can sort of choose between debt, equity, and preferred. If you have less equity, your cost of equity goes up, and your cost of debt will also go up. Preferred equity, addressing that specifically, is in between debt and equity. That's how credit rating agencies view it. That's how equity analysts view it. So, and the cost of it is in between the cost of debt and the cost of common equity. So one way of thinking of it is that the preferred share of that Énergir currently is deemed to have was allocated to common equity and to debt. We are split of 60% to common equity, 40% to debt. It's a little bit less to common equity than what DBRS, which is a credit rating agency, would have done. That was to be conservative. It's also taking into account what I'll get into later, which is that at 43% equity, Énergir will be able to meet, and 10% return on equity, Énergir will be able to meet its credit metrics. So that was the two considerations. And I also list on this page that because Dr. Brown says the business risk of Intragas and Énergir is similar, their common equity percentage is the same. And then I recommend a 10% base ROE plus 50% adder for keeping it fixed for 10 years. And lastly, Gasifer is riskier than the other utilities. That is also the recommendation of Dr. Brown. It's also consistent with what Énergir currently looks at for Gasifer, and therefore we need to increase its common equity percentages. So that's where we are currently sitting. I would say here, and I heard some questions from the tribunal yesterday in this regard, is couldn't we just increase the equity percentage? For example, for Intragas currently has more equity, and then would use the return on equity. And that's certainly a possibility. You could, instead of having this 10.43, you could have 46 and a slightly lower cost of equity. That's an option. Both 43 and 46% equity would be in the range of what I consider reasonable. Does that address your question?
It does.
Thank you.
Okay, so next slide on the key concepts. Maybe we can do a few of those key concepts, and then when it's time to break, I don't know what the Régie wants in terms of the lunch break. Would you prefer to go to noon? Okay, no, so let's go on, and so we'll do the first key concept, and then we'll see where that takes us.
So I want to make sure we all understand the key concepts before we get into the nitty-gritty details of what we are actually doing in estimating the cost of capital. I think all financial economists will agree a key concept in financial economics is the risk-return trade-off. The higher the risk of an investment, the higher the return needs to be. And that's what I have depicted in this chart we see right here. Importantly, the chart starts at that dotted line where you have what I call the risk-free rate. That's the return on a risk-free asset. You cannot have a lower return than that on any kind of an investment. And then it moves upwards so that the higher the risk is, the higher the return. That's a key concept. Two other key concepts that will become important is, one, the cost of capital. What do we mean when we say that? Is the expected return on alternative investments of equivalent risk. And I will underline two things here. One, it's an expected return, not the current return, not a historical return, but the expected return. And the other key point here is equivalent risk. That comes from the fair return standard. We need to provide investors with the same return as they can get elsewhere. And elsewhere is the marketplace. And lastly, and that's just a definition, let's look at what is systematic or non-diversifiable risk. It's the risk that investors cannot avoid by holding a diversified portfolio of assets. That's distinct from business risk that Dr. Brown was talking about earlier, in that it's the risk we measure in the marketplace. It's not related to risk that can be mitigated in other manners. So it's, and let me just say the word, it's where we measure by beta, for example, in one of our models. So that's the key concept we need to know. And if we can go to the next slide. So how do we actually go about determining the cost of equity? One thing that's really important to note is that we cannot observe the cost of equity. It represents the rate of return in capital markets. That's the key concept. We need to look at publicly traded issues to determine anything about the cost of equity. So that's where we get back to what Dr. Brown was talking about earlier. We cannot look at subsidiaries of companies if we want to estimate the cost of equity. We need to look at traded entities. They have to have publicly traded securities.
May I ask you, Dr. Vladsson, to speak maybe a little slower, because we're advised that it's maybe difficult for the translation. So I'm sorry about that, but go on your key concept. Just a little bit slower.
I'll do my very best. So that's why we look to publicly traded entities. As a result, what we often do is we select a sample of publicly traded entities. We select those so that they have comparable business risk to the degree we can. And then we apply financial models to determine what is the cost of equity for these comparable business risk entities. And we do so using various models that estimate the cost of equity. And a couple of models are commonly preferred. So most analysts would look to the capital asset pricing model, or the CAPM. And another commonly used model is the discounted cash flow model, or the DCF model. And in my opinion, it's important to look at least at a couple of models, because all models have pros and cons, and which one dominates at any one given time is a question mark of what the data shows you and what economic environments is. So multiple models are important. Moving on to the models, let's go to the next slide. The first model, the capital asset pricing model. It's based on financial economics, and I won't go through the criteria because I think everyone would be bored by then. But what it essentially says is the cost of equity is equal to a risk-free rate plus an amount. That was what we talked about before in the risk-return trade-off. You need to add as you add risk. We add a factor that determines a systematic risk. We call it beta. And then we multiply that with a market risk premium. And I've illustrated that over on the chart where the CAPM line shows how it relates. The beta is on the x-axis and the cost of equity is on the y-axis. The beta is the slope of this line. And what you can see is the market risk premium at 1 is simply the rate over and above the risk-free rate that investors require to hold equity instead of a risk-free asset. The cost of equity is always higher than the risk-free rate. So the higher, all else equal, the higher the risk-free rate, the higher the cost of equity. All else equal, the larger the systematic risk or the beta, the higher the cost of equity, and all else equal, the higher the market risk premium, the larger the cost of equity. Importantly, especially the risk-free rate and the market risk premium interact. So you can't just say if you increase 1 by 1, you would have the similar increase in your cost of equity. That would not be a true statement.
What relationship is there, in your opinion, between the risk-free rate and the market risk premium?
In general, especially if we look at a forward-looking market risk premium, as the risk-free rate increases, you will generally see the market risk premium decline, because the market risk premium is the rate investors require to hold equity over and above the risk-free rate. So you subtract the risk-free rate from the market return, essentially, to get the market risk premium. So those two will generally move in the slightly opposite direction.
I don't know if I'm the only one, but I lost your sound completely. Est-ce que vous m'entendez? Est-ce que vous entendez le Dr. Vladson?
Oui, très bien.
OK, je m'excuse. Moi, mon son a coupé, mais c'est revenu là. So I'm sorry, Dr. Vladson, if you could go back, because I did not hear your answer. So the relationship, I got the last, it's not a one-to-one, but I didn't get what you said before.
So in general, what happens is if the risk-free rate increases, there will be a decline in the market risk premium. It's not as if the risk-free rate increases by 1%, say. The market risk premium will not decline by 1%, but it will decline on average.
Will it decline more or less than 1% if it's not 1%?
Less than 1%.
So what would be the total effect on the cost of equity in that theoretical example?
I can't give you a precise answer here, simply because there is no such answer. It depends on the time.
Okay.
But historically, you're probably seeing an increase in the cost of equity of 0.4 to 0.6 of what is the increase in the market, in the risk-free rate. So it's not a full increase, but a part of that increase.
Okay.
That's historically, but it all depends on where you are on the line. Let's go to the next slide. The other key concept here is the discounted cash flow model. And what is that? In the discounted cash flow model, the current price of a stock is the present value of the expected stream of cash flow that accrues to stockholders, discounted at the cost of equity. Again, a couple of things are important. It's the expected streams of cash flows, not the expected streams of dividends, which is often confused. It's the cash flows.
So aside from dividends, what else can there be that's going to count in the cash flows?
That could be, for example, share buybacks would distribute cash to shareholders. So that would be another way of doing it. There could be a buyout or anything else. If we assume that dividends are the only distribution to shareholders, and if we assume that dividends grow at a constant rate, then the cost of equity can be determined by this formula we have in the middle. The cost of equity is simply the expected dividend in the next period over today's stock price. That's the dividend yield plus the growth rate in dividends. If we don't have that simple relationship, and for example, the growth rate varies over time, we will have to build a more sophisticated model to determine what that cost of equity is. It can still be done.
How would you go about doing that briefly?
I would build a spreadsheet where I model out the first several years. For example, I have 5 years of growing at the company-specific growth rate. Then I have 5 years maybe of growing at a rate that converges towards the general GDP growth rate. And then after that, I assume it goes at the GDP growth rate. That's how I model it. And then you use a various solver mechanisms to figure out what that means for the cost of equity.
Thank you.
Last key concept, capital structure. We've heard a lot about that already.
So that would be the next slide.
Next slide, please. So I will start at my illustration on the right-hand side here, which is taken from a textbook in corporate finance, the text of William Myers and Allen. And I think that will help clarify a few things. For what they show in the middle is the expected return on assets. And notice that I say assets, not equity. That's the expected return on the company's total asset. And they show that as being constant over time. It's a simplification, but it's constant in a reasonable range. And what they also show at the top line, the one that's going up above the blue line, is that the expected return on increase capital, that the cost of that also increases as you increase about earlier on, that there is no such thing as a optimal. You can't say that 43.234 is the optimal percentage of equity. That's a range of optimal equity structures. So that's what this chart is illustrating. What that means for the cost of capital or cost of equity determination is that one, if we are looking at two otherwise identical firms, and we're looking at one has a high level of equity, one has a low level of equity, the one with a high level of equity needs a lower return on equity or lower cost of capital, cost of equity, than the one with a high level of equity. Low level of equity, so my apologies. We talk about the level of debt as being the financial risk because it puts risk on equity holders. Because remember, debt investors have a higher claim on a company's cash flow than do equity holders. And should things go really wrong and we have a default, all the assets goes first to debt holders before equity holders get anything. It also, a higher level of debt simply reduces the amount of cash flow available to equity holders. It's also that level of capital structure or amount of debt and equity is important also for credit metrics analysis, particularly most of the credit rating agencies have targets for what you should be having in terms of the percentage of equity or in terms of how well can you cover the interest you have to pay, etc. How do we look to this in terms of actually adjusting for one company has a low percentage of equity, one has a high? Well, we look to two methodologies we can use to account for that. The one I focus on is what I call the Hamada technique in the capital asset pricing model. What it does here is that first you take the beta you have estimated for, or the systematic risk you've estimated for any one company at a given capital structure. You determine what the beta would be if you had 100% equity. That is, you unlever your beta. So you get your asset beta or your 100% equity beta. Then you relever it to the, in this case, 43% equity recommend for the utilities. And that's the beta that's relevant to apply for the utilities if they have 43% equity. You could also use the after-tax weighted average cost of capital and hold it constant as is shown in the chart here. I calculate all of these results, but I also make sure that all of my recommendations are fully supported by the Hamada technique. And the reason for that is that the regime in 2009, 2010 decided they didn't want to rely on the after-tax weighted average cost of capital methodology. So for that reason, I don't want to rely on it either. And the regime has, to my knowledge, not previously actually looked into the Hamada methodology. That concludes my slide 10. So this is just a summary of what I do. I use the...
So maybe we can do the summary and then perhaps it would be a good time for a break. Okay.
So the summary of what I...
I'm sorry? Je m'excuse, Monsieur le Président.
Oui, je trouve que vous faites une bonne proposition.
Parfait, merci. So go on, Dr. Vladson.
So I'll be brief. I've talked about this before. So in terms of what I actually do, I select a sample, a Canadian utility sample and a US gas LDC sample. Dr. Brown was asked about those. And I also support it by a US water utility sample. For each of these companies in those samples, I implement the capital asset pricing model. I also implement an empirical capital asset pricing model. And I'll talk about why I don't emphasize that so much here later. I also implement two versions of the discounted cash flow model, a single stage, which was what we had the formula for, plus the one Mr. Ouellette asked me to describe. And then I look to how do we actually take the leverage of the companies in the sample into account in relation to my recommendations for the utilities. I also have to determine what is actually the capital structure I should recommend for these utilities. I go about that by looking at their current capital structure and a series of different allowed returns to determine at what level would they be able to meet their credit metrics. Once we know what is the level they need to meet their credit metrics and what we can look at, we can estimate that, go back and estimate the cost of equity at that level. So that's my approach to looking at this approach, and that's what my recommendations I looked at earlier were based on. I'll get into more details, and especially where Dr. Booth and I disagree as we get into the issues, as I called them up front, the 5 issues.
Okay, so when we resume after lunch, we would be at slide number 12 of your presentation.
Thank you.
Merci. Alors, on se revoit à 13 heures.
Parfait. Merci beaucoup.
Merci. Rebonjour.
Rebonjour. Je vais juste ajuster. on écran. Okay. Dr. Vlachin, are you ready?
I'm ready.
Okay.
So let's go to the next page.
I think we're on slide number 12 now, before we left off.
Yes. So before we get into all of the details of how we estimate the cost of equity, I just wanted to look at some key economic and financial risks. And what is on this slide is all taken from the Bank of Canada's June 1 press release. So that's new relative to my filed evidence. And that's also why you will see later I actually updated my evidence to check that my recommendation was still valid. Key things that the Bank of Canada points out is that we have a rising inflation. It's now quite high, 6.8 in April. We have a slowing global economy. In part due to that growing inflation, it's not just Canada, it's also the US and Europe has high inflation. And since my evidence was filed, we've seen as an invasion of Russia in Ukraine. And we have significant supply chains disruption around much of the world. And all of that has led to some significant increases and decreases in stock markets in recent years. And as the Bank of Canada says, with the economy in excess demand and inflation persisting well about target, we are expected that interest rate will need to move up in the near future. So that's an important consideration to take into account.
Where did you take that quote from?
That comes from the Bank of Canada. It's the most recent policy statement from the Bank of Canada. June 1, 2022. Next slide, please. And we can actually move 2 slides ahead to slide number 14.
Okay, so we're getting into what we've called the key issues or the main differences between yourself and Dr. Booth. Perhaps you want to name them and then we'll go with the first one.
Yes, the key differences here, I took 5 of them, and the first 3, the interest rate, market risk premium, and the systematic risk or beta, are all inputs to the capital asset pricing model. The growth rates, which is number 4, is a key input to a discounted cash flow model. And then last, there's the capital structure, which affect both the credit ratings of companies, and it also affects what level of the cost of equity we should actually assign to the utilities. With that introduction, let's go to the first key issue, interest rates. And here on slide 15, over on the right-hand side, I depicted the Canadian 30-year government bond yields from 2000 until May of this year. And then I also where the dotted line is, and to the right of that is a forecast. There's also a little dot there that's indicated by a yellow arrow. That's where we were when I filed my evidence. As is clear from the chart, we've been going up since. And we're expected to go up further according to the forecast. It has become common to use a yield on a long-term government bond for the purpose of estimating the cost of capital for utilities. And I prefer to use the forecast, the best possible forecast for the period where the rate or the cost of equity that we determine here will be in effect. Dr. Booth in terms uses what can best be referred to as a normalized risk-free rate. So we have seen an increase, so clearly what I would use today is higher than what I would have used when I filed my evidence. Dr. Booth is somewhere in between. And I want to really emphasize that it's important to recognize that interaction between interest rates and the market risk premium for 2 reasons. One, as we talked about before, they move somewhat in conjunction. And second, you cannot go out and say, I want to use the yield on a 30-year bond and then use a market risk premium that's over something different. They have to match. That's important. So the second issue...
And just before we go to the second issue, what does Dr. Booth do when you said they have to match? Does he match them?
It's not clear because I'm not quite clear about how Dr. Booth comes up with his market risk premium.
Why do you say that?
I can explain that if we go to the next page.
Okay.
Or go down into that. So I'll explain as we get into the market risk premium why it's not clear. It's also a key input to the capital asset pricing model. And it's what you would get over the risk-free rate in the stock market. You can usually look to the TSX index. I look to the past and to the future. Specifically, I take a number.
Oh, please. Votre image a arrêté là, il y a une petite seconde. Il faudrait répéter la dernière phrase, s'il vous plaît.
Yes, we're also having issues with the sound here in our room, so maybe we can go back, Dr. Vilatsin, a few, maybe start over this slide number 16.
Sure. Can you hear me now?
Yes.
So the market risk premium is the return that investors require over and above the risk-free rates. So if we use a 30-year rate, it's over the 30-year risk-free rate. In Canada, we usually look to the TSX for that. In the US, we would look to the S&P 500 or some other big market index. I look to the past and to the future. So I look to what has historically been earned over and above the 30-year rate. And I calculate long-term average. I also look to the future in that I've looked to what does recognized financial data providers forecast the market risk premium will be. If you look back, you should look back a long period of time because textbooks will recommend that it's a better representation of all kinds of conditions. In turn, Dr. Booth looks to historical averages. He also looks to surveys, and then I'm not clear exactly how he mixes those up to come up with his results. We might be able to see that better if we go to the next stage, next page, page 17. So what I listed on the top here was there was results I got when I did my original analysis. I got a historical market risk premium of 5.68 at the date of filing. It has since increased to 5.91 because 2021 data became available. And the market risk premium as determined by Bloomberg's forecast has declined from 8.1 as of the date of filing to 5.9 as of May 2022. So we've seen a movement in both directions. I'm not clear how Dr. Booth arrives at his number. He looks to the history only because his surveys ask people, what did you use? Not what will you use, but what did you use? And then he says that's an average of 5.5 to 6 or a midpoint of 5.75, which is below that historical average I find as of May. He does not consider anything about the forward-looking MRPs, and he does not have a calculation that shows how he comes up with his 5.5 to 6.0. That's why I say I don't know exactly where the number came from. Slide 18. And we get to the third key issue, again, an input to the capital asset pricing model. That beta. What I depicted over on the right-hand side is how do we determine a beta? So each of these little dots here indicates where I, on the x-axis, have a market return, and then the y-axis, I have a company-specific return in the market. And then I find what is the best fitting line in a statistical sense. In other words, where are the variations around the line the smallest? That's my regression. And that slope is my beta. And that captures how does the market, or how does the individual company's risk vary with that of the market? That's what it captures. I think one should look to 3 to 5 years of preferably weekly data too short a period, you don't have enough data to get a statistically high quality estimate. Too long a period, you fail to recognize changes in the industry. And that's an important issue. I also use that Bloom adjustment, which importantly moves the beta toward a value that statistically provides a better forecasted beta. It's not a matter of moving it towards 1, which is what many people will say. It's a matter of providing the best possible statistical forecast.
What do you mean? But you just said it's not a matter of bringing it close to 1. That's what people say. What are you referring to?
So, for example, Booth will say, I move it towards 1. That's not my intention. My intention is to provide the best possible forecast of the beta. Slide 19. And in the last cross-examination, we heard a lot about samples. So let's look at the samples. I selected 3 samples, of which I'm showing 2 here. And those are the 2 I relied upon. The Canadian regulated utilities and US natural gas distribution utilities. I also looked to US water utilities as a check on the other 2 samples. So how did I go about coming up with these samples? I looked to what are actually companies that are listed as other Canadian utilities. They have to be listed on a stock market for me to use them, or what is listed as US natural gas utilities.
Why do you say they have to be listed on a stock market for you to use them?
Because before I said I needed to calculate my beta, which is the market return versus the return in the market on an individual company. So I have to have a company that is publicly traded. So I took all the companies that were classified as such, and then I start looking at what do these companies do. Clearly, they need to have enough data that I can estimate my results. They need to be at least investment grade, otherwise there's problematic issues. If I want to do the discounted cash flow model, they need to pay dividends. And then I eliminate any company that is actively involved in a very large merger or acquisition, because that impacts stock prices. And once I've done that, I look to what do these companies do. And for me, the key thing here is regulated assets. You need to have sufficient amount of regulated assets that you actually can qualify as a regulated entity. And assets are important because that's what we enter into the rate base and earn a return on. In terms like revenues, for example, vary widely from year to year. That's good measure. So I look to assets. And what percentage is regulated? I'm not so concerned about whether you are engaged in, say, providing gas distribution or electric distribution. It's more important that you are highly regulated by the provincial or state regulator. So I look at that for all of those companies. And I list over there on the right-hand side, you have the Canadian sample. And not only did I provide, as is in my testimony and what we looked at in the prior testimony, whether they are higher than 80 or not, but also the actual percentage. So you can see what the percentage of regulated assets is. And I would also say that I have a couple of dots over there to the left of the tables. Those are companies that since the filing of my testimony have engaged in substantial mergers or acquisitions, and therefore I would not include them today. One thing to note here is, of the gas LDC sample, which we've heard a number of criticisms of, and we might talk more about that later, but these companies all have a quite high regulated asset mix. The only company in my US gas sample that does not have more than 80% regulated assets is New Jersey Resources. So yes, it's true that some of these companies certainly have water distribution, electric distribution, some even have pipeline segments, but the pipeline segments are by and large gas pipelines that serve their own customers. and are treated similar to other assets. So that's what the companies look like. For each of these, I estimate the beta, and then I look to what would that result in terms of the capital asset pricing model's cost of capital. Next slide, please. And what this here shows is on the right-hand side, I have 3-year weekly betas. For the green line is the Canadian sample, the blue line is the US gas sample. And what we can see is they both have moved up in recent years. And what is also important to notice here, there was a period of time when especially the US gas LDC sample actually moved down and then it came back up. And I think here I use 3 years weekly beta. I think it's important to use a long enough period that you can get statistically valid results. But also, as Dr. Booth says, betas change through time as the risk of the underlying assets or portfolio changes. Therefore, you also need to make sure that it's current enough that you can take that into account. That's especially important in something like the gas industry that currently changes. I want to address a couple of issues with Dr. Booth's testimony. Dr. Booth chooses a beta of 0.5 to 0.55. The average beta he himself estimates in his appendix for his Canadian sample is 0.74. So that's an important.
Do you understand why that's not the figure he uses?
I can't speak for Dr. Booth. In terms of should we use adjusted versus unadjusted betas, as I said before, it's an adjustment that's made to get a better reflection of the future beta. And I also want to mention clearly that if we look at today and my average beta is about 0.85, it really doesn't matter much whether you adjust it or not. There's 0.05 change difference. Whereas if you did it at the average of, say, Dr. Booth's sample, it does matter. It does not matter with the numbers I use, which are today's numbers. Next slide, please. So this is just a summary of our differences. And I don't think I want to spend a whole lot of time on that. I use 3 and 5. I present 3 and 5 year betas. My results use 3 year betas. That's not much of a difference. Dr. Booth looks back up to 20 years. He does provide estimates, which I believe are 5-year monthly betas. They are higher than what he uses. And the last I want to say is that I have, and many others have moved to use of higher frequency beta than we would have done 10 years ago. 10 years ago, entities such as Value Line would use monthly data to estimate their beta. Today, they use weekly. So does someone like S&P Global Intelligence. Again, they use weekly today. Bloomberg, I believe, has always used weekly betas. And that's why I believe today it's appropriate to use weekly betas.
Can you briefly explain the difference if you use weekly versus monthly? What's it going to change?
So there's 2 things that really changes. One is that if you use monthly, you have to go back further to get enough data. So if you use 3 years of monthly data, you would only have 36 observations. Whereas you use 3 years of weekly, you have 156 observations. That's a lot more and get you better statistical results. Second, if you go back that far, you don't capture today's environment. Second, depending on circumstances, you might fail to capture interactions in between. So most stocks will change on a daily basis. So if you only measured once a month, you're getting very delayed measurements of any changes in that. Okay. Slide 22. Next issue, now we are moving to discounted cash flow, which is the other model. And here we are looking at the growth rate, which is usually the controversial part of that. It represents the expected compound annual growth in a company's earnings over the next 3 to 5 years. I use consensus forecasts. That is, forecasts that are aggregated by data providers, as many equity analysts as they can find who provide a forecast. In the multi-stage DCF, that growth forecast is combined with a forecast on the long-term nominal GDP growth, and usually we taper it up or down towards that growth over a period of time. I use 5 years for that tapering. Next slide, please. And on slide 23, I'm trying to illustrate the key differences between Dr. Booth and myself. Dr. Booth criticized analyst growth forecast as being upward biased, and he also criticized the use of earnings growth. I have a problem with Dr. Booth's criticism, and my problem is really that Dr. Booth relies on generic research on whether or not analysts upward biased growth rates for, say, the TSX. That's not what we're looking at. The relevant question is whether or not the growth rates for the utilities we're using in the samples is biased. That is utilities, highly regulated utilities. Such utilities are generally more stable, have longer histories, and more assets to revenue, and therefore their growth rates, according to research, is much more reliable. I would not necessarily disagree that a tech company, such as, say, Google, or you can name it, have highly unreliable growth forecast. The other thing I would be concerned about is when he looks to industry data, he looks only up to 2015 to 2018, not contemporaneous data. And there's been a number of initiatives on the way to try to eliminate that growth bias. The last thing I'm concerned about is looking to GDP growth for the discounted cash flow model is problematic. It's possible that utilities growth converts to that, but clearly we have better data in the near term. Clearly, companies such as the utilities or companies in my samples, both equity analysts and the utilities themselves have ideas about where they're going in the next 2 to 5 years. So we should never use just generic growth rates for the near term. And the last thing, just to address the issue of whether we should use earnings growth. Ultimately, all earnings accrue to shareholders. That's the first thing to note. So they will get them. It's a question of at what time. And second, if you want to look only to cash flow that accrues to dividend in any one given period, you need to look to all cash flow that accrues to shareholders, not just dividends, but also, for example, share buybacks or any other cash that might accrue. Share buybacks is the most common. So those are my comments on the DCF model. Next topic, and that will be my last topic on this issue, capital structure. The first thing I put on this slide is a cite from a textbook, the Burke and DeMarso text from 2013, which I also cited in my evidence. And what is important here up in the blue box, the levered equity return equals the unlevered equity return plus an extra kick due to leverage. What do they mean by that? They mean the more debt you have, the higher the cost of equity. So that's a fundamental issue in corporate finance. And importantly here, when we go out and measure, for example, I've said that a couple of times, when we go out and measure betas or any other return data, we go to the market. Therefore, we measure everything in the marketplace using market data. So the relevant capital structure is also based on the market. That's important. And as I told you earlier on in this presentation, there's multiple ways we could do that formally to actually get a number out of these results. I chose to focus on the Hamada approach. That's the key methodology I use, and I make sure all my results are supported by that. We can also use the after-tax weighted average cost of capital. I chose not to rely on that because the WC in the past has not appreciated that method.
Can you maybe just give a little bit more details on the Hamada approach?
Sure. So the Hamada approach, and I'll use two versions of it. But basically what it does, it says, okay, I've estimated a beta in the market, and say the company in the market has 60% equity. So the first thing I do is I go out and figure out what should that beta be if I had 100% equity. That's my unlevered beta. Having done that, I now go back and say, well, my target utility, say, in this case, Energia, Gasifer, and Intragas, I recommend the benchmark of 43%. So what would the beta be at 43%? I re-level the beta to 43% equity. In doing so, I take into account in one of my methods, what is the impact of taxes? The other method does not, but you can do it with or without taxes. So that's basically what it does to come up with what should you be doing. The last thing I wanted to address in capital structure, and that's on page 25, is one of the data requests from Dr. Booth to myself looked at market to book ratios. And basically the suggestion was that if the market ratio to book ratio is above 1, so if the market value of equity is higher than the book value of equity, you're earning above your allowed return, what the return should be. That's a very simplified and misconstrued conception for several reasons. When we look at market values, we look at the value of all the assets of the traded company. It could be regulated entities, unregulated entities, growth opportunities, etc. All of these things would be included. So it's important, it's not, even if you have a company that's 100% regulated, the market value does not just reflect what you currently have as your assets. It also reflects growth opportunities. So you can't say that that should be 1. It does not mean that a utility is at risk of having its capital structure changed or having its stock price drop or having its allowed return cut. It's just a measure in the marketplace of what investors believe they will pay for that asset. Slide 26, please. The last thing I want to say about capital structure is, in Dr. Booth's testimony, he critiques heavily the reliance on the HEWAC method, but barely mentions the Hamada approach. And the other thing that's important to note was he has not previously addressed the Hamada approach, so I think it's does everybody else get a feedback? Okay. So the WC has not previously addressed the Hamada approach, so therefore I will present that to them in this case. And I want to make sure that people understand, and especially the WC understand, that it does consider the impact of taxes, and that my approach is completely supported by the Hamada approach. The HEWAC numbers that I report in my evidence are slightly higher. I ignore those for the purpose of my recommendation.
So you did not use the ATWAC method for the capital structure?
I used it in my DCF methodology, but everything I recommend has to be supported by the Hamada approach, or I cannot recommend that number.
Okay.
Next slide, please. Just to summarize my recommendations, and I did that up front also. The benchmark ROE is 10% on 43% equity, so 57% debt. And that's a reset, basically, as we talked about earlier on. And then we recommend that Gasifair is getting a higher equity percentage because Dr. Brown, and as the WC has previously recognized, is riskier. And for Intragas, which is requesting a 10-year fixed rate, we recommend a 50 basis points added to that return on equity. It's also true when we get a little bit towards the end of my presentation, I'll talk about how I look at credit metrics, and I'll also then discuss why these numbers make sense. I can also say, for example, that 43% equity is the same as taking Energia's currently 38.5% equity and 60% of its current 7.5% preferred and allocating that to equity and then the remainder to debt. So we're just removing the preferred. Last slide in this section on slide 28. I don't want to go into details on Dr. Booth's recommendations. I obviously disagree because we have two very different numbers. But what I would say is it's not based on, I don't know where all of his numbers come from. It's not based on utilities that face similar business risk. He does not take a sample and estimate a number. He does not consider the financial risk. It's also true that Dr. Booth relies on data predominantly as of January 2022. And since then, obviously, economic and financial conditions have significantly changed. I also would take exception to anchoring any kind of an ROE decision to a decision made in another jurisdiction pertaining to a different utility. I don't think that's a way of setting ROEs. So the last thing.
Why do you say it's not? You don't think it's a way of setting ROEs to look at a decision in New Brunswick?
Because if every regulator went out and looked at all the other decisions and set the ROE at the same, it would be circular. We would never move anywhere. What I believe any regulator and the WC and any other regulator should do is to look at the evidence in front of them, take the best possible evidence and come up with their decision. That's what I believe every regulator should be doing. And that, of course, takes into account today's conditions, not what the conditions might have been in New Brunswick whenever that decision came out. And also takes into account whatever the specific circumstances are in Quebec. So the last thing I want to do here on Dr. Booth's estimates is to look at what happens to his estimates if we take his data and just do very simple modifications to them.
Maybe before we go there, I don't think you covered the last part of that slide on page 28. When you say Dr. Booth ignores his own data, what do you mean by that?
I mean that Dr. Booth estimates a beta for his Canadian sample to be 0.74. But he uses an average beta of 0.5 to 0.55. I don't know where that number comes from. Dr. Booth says his MRP estimate is 0.5 to 0.60. And I again don't really know where that number comes from. He doesn't have a specific source. And then he has this bond borrowing adjustment that I'm not really sure where it comes from either. So he has a number of things where there's not one specific source where it comes from. Therefore, it's not clear to me how he comes up with his estimates. And I think we can go to slide 29. And all I did on this slide is to take all of the next slides have the same format. They have Dr. Booth's testimony page 85. He has the two left columns, the low and the high. So it's all Dr. Booth's risk-free rate, his adjustment for bond buying, and then the 0.5 to 0.55 is his beta, his market risk premium, and then his flotation cost adjustment. And for simplicity, in all of the following slides, I just took the average of his market risk premium to not have two columns. And then all I'm working with here is the beta. Assume Dr. Booth had used his estimated Canadian sample beta, 0.74. What would he get? 8.56. It increases his results, his recommendation from basically 7.5 to 8.5 or 8.6. So that simple change would change his estimate dramatically. Next slide. Assume we Bloom adjusted that beta estimate Dr. Booth comes up with so that we take into account that a Bloom adjustment provides a better prediction. That gives us a beta of 0.83 and the estimate become 9.05. So again, that will move it up a little bit. Look, let's look at the next slide, slide 31. Now let's take Booth's beta, the 0.74, and do the Hamada adjustment, unlever it and then relever it so it becomes consistent with a 43% equity. And it becomes 0.85 and his results is 9.17. So we can see that it's all moving his numbers up in something that's over 9 pretty much. The last slide I have on this is on slide 32, where I looked at Booth's US sample beta, and then I did a Bloom adjustment to that beta to see what would that result in. His beta becomes 0.9, and now his result is 9.5. So even these small changes to his beta estimates results in estimates that are quite a bit higher. So that's where I really have the main problem with Dr. Booth's estimates. He does not go out and take a sample and estimate his betas and then say, this is what we should use. So that would be my recommendation here. We should look at these issues. The last segment of my presentation is really looking at the cost of equity estimates and recommendations and also the capital structure recommendations. And I want to do that fairly quickly so we don't have too much time, but I do want to show you what the results are and talk about a couple of things that has been criticized. And I again talk only about the Canadian sample and the US gas sample, not about the water sample. The first here shows my numbers at the time of filing for the Canadian sample and the natural gas sample. I show first the capital asset pricing and ECAPM-based numbers, and then the DCF-based results. And I'll only focus on the Hamada adjustments because, as I said, I don't want to look to the HEWAC models. And one of the things you can see, regardless of where I look on this table, 10% is in between these two rows, the high and the low number. That's what we found. I also want to point to that Dr. Booth criticized the use of the empirical capital asset pricing model as being a way of upward adjusting the results. What we actually can see on this table here is it actually slightly downward adjusts the results, depending on where you look. So it's about 0.1 lower than what you actually, and that's the ones in the boxes. They are about 0.1 to a little bit more than that, to 0.4 below the number that's right above it, which means it has a slight downward adjustment. So what does that mean? Well, my reasonable range before any kind of adjustment is 9.25 to 10.75. So basically 10% is right in the middle of there. That's my reasonable ranges. Dr. Brown says that the utilities in Quebec are slightly riskier than my US gas LDCs. I have a little bit of an issue here in terms of actually placing them because, as you can see, at the time of my estimation, the capital asset pricing model was slightly lower for my Canadian sample than for my US sample. And so what I decided to do here is to actually not go to the upper half of the natural gas sample simply because I wanted to take into account that maybe there's something Canadian specific. So it became more like the middle. And I wanted to make sure I was inside that 10.5 I see from the Canadian sample as my recommendation. So 10% is in all of these boxes and therefore reasonable recommendation. In terms of actually, now this year was based on data as of last summer, and we filed in November. So a lot has happened in the world since then. It's a very different world. So I thought it would be prudent to update the estimates, and especially to do so to make sure that I was not overestimating the cost of equity, that there was nothing that indicated I should change my recommendation. In terms of just what has happened, is that forecasted interest rates as well as actual interest rates has increased by almost over 1%, 110 basis points. Inflation has risen dramatically. And the historical market risk premium, one of my measures, have increased, whereas actually the forward-looking market risk premium has declined, which I'm not overly surprised about. I'm surprised about the level of the decline, but I did expect it to decline given interest rates were increasing, but it declined by more than that, so that's a little surprising. I also checked the betas to see that there's nothing there. The average of my samples remained the same, even if I actually changed the sample slightly. In terms of the discounted cash flow models, growth rates for the Canadian utilities declined slightly, but they actually increased for the US gas LDC sample. So overall, what actually happened here is, and that's mostly driven by the fact that the growth rates moved the way they did, and then the difference between the historical and the forecasted MRP narrowed. So all my results narrowed the range. That's what happened essentially. So if we can go to the next slide, I'll show you the reasonable ranges. So here what I have is over on the right-hand side is my reasonable ranges at 43% equity as of filing. And on the left-hand side is my model as of May 31st, which is the most recent I could update to. And what we can see is my ranges are much narrower than what they were. The upper end came down. On average, the low end came up. So I narrowed my range. And what I see here is that, well, 10% is inside the range still of everything except for the Canadian sample, CAPM, ECAPM. On the other hand, 10% is below the DCF model for the Canadian sample now. So based on this and based on Dr. Brown's testimony that the natural gas sample is the best comparable, 10% remains a valid number. There's no reason to change our recommendation. So it's still supported by numbers, and I thought that was important given the changes in the economy. The last thing I want to talk about is how did I come up with a 43%? And as I said early on, there's not one capital structure that's perfect. There's no optimal capital structure. There's reasonable capital structures. One of the things that puts a limit on what is a reasonable capital structure is credit ratings. If you want the utilities to have a solid credit rating, say an A rating, you need to be able to satisfy the benchmarks credit rating agencies have for such utilities. And I listed here on this slide some of the key things. DBRS, the Canadian credit rating agencies, Moody's, a US credit rating agencies, and S&P, again, a US credit rating agency, look through. So they have on the left-hand side here in my table is their benchmarks. It all consists of ranges. So for the earnings before interest and taxes coverage, that is how many times can you cover interest. DBRS says it has to be between 1.8 and 2.5.
You said 2.5. I think I have 2.8 on the slide.
2.8. That should be 2.8. I can't read it. It's too small.
Okay.
And the other benchmark they use, especially Moody's, like the funds from operation, how many times can that cover interest? It's a slightly different measure. You measure it because you actually add back depreciation to that. So it's funds from operations measure. They say 4.5 to 6. And all of the credit rating agencies look to funds from operations to debt. How many times can you actually have that covering? What is that in percentage of the debt is how they usually measure that. And as you can see, it's they're not exactly the same. So DBRS is a little bit more lenient than the others. So that probably reflects the Canadian market. And the other thing I looked at, what do actually A-rated Canadian and US utilities look like in terms of these measures? Go out and look at what do Canadian utilities, according to DBRS, on average have according to these measures. And that's what I listed on the right-hand side. That's another important consideration. How do we make the utilities look like the rest of the world? And interestingly enough, you will see that none of these have anything near the lower bound of these measures. There's nothing near there. And I also think it's important to not be at the very low end, but be somewhere in the middle of these ranges. So that's what we're looking to. And how do we do that? Well, that's where the data I said I got from the utilities come into play. I got all this data on depreciation rates. What do you have in terms of what is your actual interest you're paying? And then we built a model where we have a hypothetical $1,000 rate base. And then we say, well, if you have 10% return on equity and each of your utility specific embedded cost of debt, each of the utility specific depreciation rates, each of the utilities construction work in progress in proportion to the asset base, and look at what would that actually mean for all of these ratios here. And then we calculated at various cost of equity estimates and at various, and see what capital structure do we need to get something meaningful. And that's what is on the next page. And here on the last, can I have the next page? And here what I'm showing it at 10% ROE. When we actually did that, we did for a whole slew of different ROEs and then looked at what capital structures we would look at. I also look here, not at every single capital structure, but start at 35% and move up to 55%, which is sort of what I say a reasonable range. And then what I highlighted here in green is, where do we get to something that's meaningful on all of these measures? And turns out that Energia is the easy utility on the block.
What do you mean by, you say, what we see, where we get something meaningful? What do you mean by meaningful?
Where do we get a EBIT coverage ratio that's at 10% ROE, fulfills the credit rating agency's criteria for where it should be? Say and here we look at 2.5. So if EBIT should be at 2.5, we can fulfill that at 35% equity and 10% ROE for Energia. We cannot do that for Intragas. We can again do that for Gasifair. That's what we see. We do the same thing for the funds from operations to coverage ratio. Where would we get to a combination of equity percentage and 10% ROE that actually meets that definite benchmark? So that's what I mean. So you want a whole lot of number and simulate where would you get something that fulfills all of these three key credit metrics for the utilities, using their depreciation rates, their embedded cost of debt, and their construction work in progress numbers. So if we look at that, Energia gets all of their three metrics inside the range of what the credit rating agencies want at 42.5% equity. So 43%, as we found also by taking 60% of the preferred and allocated to equity and 40% to debt. Again, we see the same number, 43% is a reasonable number to fulfill all of these. Again, we could move them up to, if we, for example, reduce the ROE, we would need to move the equity percentage up to meet those credit metrics. And we do the same exercise for Intragas with their numbers, same exercise for Gasifair. And that's where it becomes a little bit more tricky because, for example, Intragas never really gets to 15% FFO to debt at this range here. However, because Dr. Brown testifies it has the same business risk, it seems reasonable to have them have the same capital structure. And lastly, we look at Gasifair. Gasifair is the riskiest of the three utilities, according to Dr. Brown and the regime's prior findings. We also see it here. It needs to move quite up on the scale to actually meet its credit metrics, especially on the FFO to debt. So if we were to follow this scheme here, we should give them 52.5% equity. And that's where some judgment came into play, because I think 52.5 might be fine, but it is a very big change in what we are currently seeing. So I thought it would be meaningful to move them higher than the other two utilities towards that range. But in Canada, 52.5 would be high. It would not be in the US. So 45% was a reasonable compromise between the 43% for the other two utilities and the 52.5 that is needed here. So that's how I came up with these numbers, and I will end my presentation here.
Okay, I have one more question, at least for you, Dr. Velatsen. If Madame Lagreffière could put on the screen exhibit B0131, donc B0131. So we'll try to, and I understand you don't read French, so I'll just, which was not the case for Dr. Brown, so I'll just maybe translate what we see here, and we'll, maybe if we could make it a little bit bigger. Not suggesting that Dr. Velatsen cannot read it, but I certainly cannot. So to the left, we have, okay, so we have année, the first column is year. Okay, so we have the year. Taux, the second column, taux is rate. And at the top, just behind énergie, you have authorized, autorisé, and realized, réalisé. So what this is what was Énergir's authorized rate of return for a specific year versus what they achieved in terms of return for that specific year. My question, and you have the same information for Intragas and Gasifair on this chart. My question to you is, in your opinion, what is the relevance of these returns for the purpose of this hearing?
For the purpose of determining the cost of equity, it's not relevant, for the reason that what investors care about is what total return do they get in the marketplace. That is not represented by this realized accounting return. And remember, this is accounting returns. So they care about what do they actually get from both earnings in the company and for capital appreciation. All of that matters to investors. This here is historic accounting information and therefore not relevant for my purpose of determining the cost of equity.
When you say accounting as opposed to what?
Accounting as opposed to market returns.
So, Mr. President, if you could allow me just a few minutes to consult my colleagues to see if we have further questions for Dr. Velatsen.
Oui, sans problème.
Merci. I have one more question.
Yes.
Okay. Can you please explain to the Régie your understanding of the purpose and of the significance of the standalone principle?
As I understand it, the standalone principle says that a regulated entity needs to be regulated on its own merits, irrelevant and it's irrelevant who owns it or what entity it's a part of. It's a principle that comes up in, for example, the regulatory principles of regulatory economics of Alfred Kuhn's book that dates back to the 70s. It's also a principle I understand that Régie has recognized in the past.
And do you agree with that principle? And if so, why?
I agree with that principle because we are not trying to regulate any of the assets that are not subject to Quebec regulation. We are only trying to regulate the gas distribution assets and the intra-gas storage facilities. We are not trying to regulate anything else that might be under the same umbrella.
Those were my questions. Alors, je n'ai plus de questions pour le Dr. Viladsen.
Merci beaucoup. Alors, on va passer au contre-interrogatoire des intervenants.
Si vous me permettez, Monsieur le Président, peut-être juste quelques remarques introductives, and I can do it in English for the purpose of Dr. Viladsen. First, we were provided, of course, with the presentation of Dr. Viladsen just maybe like 30 minutes or 1 hour before she testified. So, of course, I haven't had the chance of reviewing it with my own Est-ce que tu peux juste m'ajuster la galerie ici?
Bon, alors on vous voit maintenant. Est-ce qu'on a tout le monde en ligne? Votre canal.
Est-ce qu'on peut vérifier de notre côté? Il semble que oui.
Mais David, vous vous inquiétiez pour Dr. Booth. Est-ce que vous pouvez
On me dit
vérifier?
qu'il est...
Je le vois dans la liste des participants, donc je présume qu'il est là. Attendez, je le voyais, mais je pense qu'il est là.
On me dit qu'il est là.
Très bien. Alors, on peut poursuivre.
Alors, Monsieur le Président, comme je vous disais, j'avais certaines remarques préliminaires à faire. Je disais que la présentation du docteur Verletin nous a été transmise quelque temps avant qu'elle témoigne. Depuis le début du dossier, on essaie d'y aller rondement. Et généralement, comme vous le savez, là, les présentations, d'habitude, on les a à peu près 24 heures d'avance à la régie. Dans un contexte aussi important que ce dossier-ci, naturellement, une demi-heure avant la présentation, c'est très court, surtout quand ça relève de l'expertise d'une part. D'autre part, il y a des données récentes. On a mis à jour, le Dr. Verletin a mis à jour son rapport. Donc, c'est des informations nouvelles que je vais devoir valider. Et il y a également, tout l'aspect de référence à l'expertise du Dr. Booth. Alors, ce que je vais vous proposer, c'est la chose suivante, c'est que je vais commencer avec certaines lignes de questions et je vais demander l'indulgence de la régie pour que je puisse avoir le temps nécessaire pour qu'on puisse assimiler là, d'une part les nouvelles informations, que je puisse parler avec notre expert au niveau de la direction que prendra le contre-interrogatoire. Alors, c'est la suggestion que je vous fais pour qu'on puisse avoir un temps raisonnable et je vais m'assurer que ça ne change pas et ça ne bousille pas l'horaire. Je vois qu'il est quand même déjà 2 heures, là, donc je vais essayer d'avancer dans certaines de mes questions, mais j'aimerais être en mesure là, de pouvoir naturellement avoir le temps nécessaire pour parler à notre expert.
Oui, ça va.
Et je voulais juste aussi, dernier point, je vais transmettre sous le SDI. On sait qu'il y a une question de confidentialité. On en parlera, ou j'allais dire on en parlera, mais on vous l'écrira dans le cadre des plaidoiries, les questions de confidentialité dans le cadre du dossier. Ce que l'on a fait, c'est que on a pris on va parler tout à l'heure du Bloom Adjustment. On a pris un exemple et on a caviardé l'information. Alors, juste pour que mes collègues le sachent, là, on va déposer un document qui est comme un exemple de Bloom Adjustment. Ça va être juste pour les fins de mon contre-interrogatoire avec le Dr. Verletin. Ceci étant fait comme remarque, je vais maintenant débuter.
Si vous me permettez, Maître Hamelin, juste, je vais passer la parole à Maître Cloutier. Il y a un aspect de confidentialité, je pense qu'on veut porter à l'attention de tout le monde là, pour le bénéfice de tous.
Oui, exact. Ce matin, avec la présentation.
Je vous entends plus.
Est-ce que vous entendez Maître Cloutier? Moi, je l'entends.
Non.
Non.
Okay. On va ajuster, ce ne sera pas long.
Est-ce que ça fonctionne?
Non. Ben, prends mon casque. Viens.
Ça fonctionnait, je pense. Ça fonctionne.
Là, ça marche.
OK.
Ne marche plus.
Ça va marcher.
Oups.
Peut-être que je vais juste demander à Maître Cloutier de prendre mon casque d'écoute pour vous dire ce qu'elle a à dire. Ça va peut-être être plus simple pour tout le monde. Ce sera pas.
Je serai brève, tout simplement pour vous mentionner qu'avec la présentation de la Dr Villatine, ont été transmis 2 documents PDF qui correspondent à certaines données qui finalement pourront être au dossier public du tribunal. C'était des données qui étaient contenues dans les annexes BV6 et BV12 au soutien du direct testimony de la Dr Villatine. Ces 2 annexes-là avaient été déposées complètement de manière confidentielle en novembre dernier. Suivant les révisions de la Dr Villatine en préparation de son interrogatoire, elle a réalisé que certaines choses pouvaient être libérées au dossier public de la Cour, donc c'est ce qu'on vous a fourni. Donc, ce n'est pas des nouvelles données au dossier, mais c'est juste que certaines pouvaient être libérées de manière publique, donc ce qu'on a fait.
Merci. Alors, Maître Hamelin, on va faire un petit bout, peut-être jusqu'à 14h30, puis on prendra une petite pause à ce moment-là.
Maître Hamelin, on ne vous entend pas.
Oui, c'est moi qui étais. Alors, hi, Dr. Villatine. My name is Paul Hamelin. I represent IGWA. Good afternoon. Just so a few questions with respect to the guiding principles in this matter. In your direct testimony, your report B15 at page 10, you referred to the criteria used by the Régie in the decision D 2009-156 to determine a fair return.
Yes.
Okay. So I understand that, in fact, what you are doing is that you are referring to paragraph 173 of the decision, the 2009-156, stating the 3 criteria, which are comparable requirement, capital attraction requirement, and financial integrity requirement, correct?
That's correct.
And just so I understand correctly, the first bullet in your report would be referring to the comparable investment.
That's correct,
criteria?
yes. Yeah.
Okay. The second one would be the financial integrity requirement.
That's correct, yes.
And the third bullet, the capital attraction requirement.
That's correct, yes.
I don't know if it's already on the Régie site, but not yet. We have sent what we have as an unofficial translation of the decision from the Régie, the 2009-156. First of all, were you provided with the decision or any translation of that decision?
I looked at the decision, yes, and I've seen a translation of part of that, yes.
Okay.
Again, unofficial.
So I do not know if my unofficial translation is the same as yours. So maybe we can try to move on. If it's not the same, I would like to have as an undertaking the copy, your translated version of the decision, D 2009-156.
So can we first see if we agree on your translation, and then we'll see if we take the undertaking?
Okay, so I'll move on with my questions, and perhaps I'll read what I have as the English translation, and we'll see if yes.
Is it possible to send us your translation so we can follow? And I'll just forward it to Dr. Villatz, and as soon as I receive it by email, it should take us a matter of seconds. It would make it easier for us to follow.
Of course. and I'm apologies to the régie. I can send it to the greffe as well, but I think it should be filed soon. Nous l'ont envoyé. Just a second. It's just that my my analyst does not have your email address in my computer. Bon, ça va bien.
Je vais vous envoyer un courriel tout de suite, Maître Hamelin, comme ça vous allez l'avoir. Là, ça va être ça qui va être le plus facile.
Maître Hamelin, je pense que vous avez le mien, donc vous pouvez me l'envoyer à moi, puis je vais le faire
circuler. Sauf que je n'ai pas mon ordi à côté de moi. Là. Il est où mon ordi?
Je vais m'assurer que... Okay, so I'm advised that Dr. Vilatsin has received what was available on the Régie website.
Okay.
So do you have that accessible in front of you, Dr. Vilatsin?
No, I don't.
Okay.
I'm sorry to interject again. Would it be possible to maybe, Madame la Greffière, to post the exhibit so for everyone to see? If it's available on the Régie's website, then it must be available to put up.
Peux-tu me sortir la page? Oh, pardon. Est-ce qu'on a le document? D'accord, merci.
Maître Hamelin, la page,
oui.
C'est la 45?
C'est du PDF. Donnez-moi 2 minutes. C'était le paragraphe 173. J'ai encore perdu.
C'est la D 2956, paragraphe.
Paragraphe 173.
Merci.
Mais ce n'est pas la version traduite que j'ai transmise. Mais... OK, ben, je peux y aller avec... I can go on with this. I'll read you what I have as a translation for each of the criteria. And Dr. Villetson, you can indicate to me if you consider that it's comparable. First of all, in the translation that I have with respect to the first criteria, with respect to comparable investment requirement, the Régie essentially indicates that it must be comparable to the return available from the application of the invested capital to the other enterprises of like risk. So
that sounds familiar, yes.
Okay. With respect to the financial integrity requirement, would you agree with the Régie's description as enable the financial integrity of the regulated enterprise to be maintained? So this is the financial integrity requirement.
Yes.
For the third requirement, the same question. I have, as per a translation, that the capital attraction requirement must permit incremental capital to be attracted to the enterprise on reasonable terms and conditions.
I don't recall if that's what I read in that translation, but I will take that subject to check.
Okay. Is it your understanding that in this decision, the Régie has essentially stated that these three criteria have historically been recognized by regulatory agencies and the courts as a basis for the determination of the fair return standard?
Yes.
And do you agree that the Régie decided that these three criteria enjoy consensus support and should be guiding the Régies in its jurisdiction to determine a reasonable rate of return?
Yes.
I now refer you to your report. Merci, Madame la Greffière. At page 11, line 3.
Yes.
You indicate that the third component of the fair return standard requires that the allowed return be sufficient to maintain the company's financial integrity such that its operations are not hampered by inadequate cash flows. Can you explain what you mean by that?
So by that, I mean that it should be sufficient that it can attract capital and that it's sufficient that it can continue its operations. That's my economist understanding of what these criteria mean.
And to your knowledge, are you aware of any decisions where for this third requirement, regulators would have taken into account that a company's operation must not be hampered by inadequate cash flows? This expression that you use.
That is my terminology and not that of a decision.
Thank you. So let's turn to the applicable methodologies. You have indicated in your report and also in your presentation today that there are multiple methodologies to estimate the cost of capital, and that you find it reasonable to use more than one methodology in the estimation process. Sorry, Madame la Greffière, I will refer again to the Régie's decision. I don't know if we have received the translation version or not.
ASIG 0077.
Parfait. So for reference purposes, I'm referring to the decision D 2009-156. It's at paragraph 38 and following. We can put it on the screen if...
Ça sera pas long, Maître Hamelin.
Parfait.
On va chercher.
Merci.
C'est ASIG 0076.
On m'a dit 77, mais je ne sais pas.
Je pense que c'est 76.
Parfait. Alors, c'est ASIG 76.
Quelle page, Maître Hamelin?
Alors, j'irai au paragraphe 238. As-tu la page?
Merci. Page 17.
So I want to draw your attention to paragraph 238, indicating that the Régie has decided to rely primarily on the capital asset pricing method in reaching its decision, and the fact that this is the method the Régie has applied in previous decisions, and in the most widely used approach in Canada. Do you agree based on these extracts? And I'll refer you just before I ask you the question, if you have had the time to read it. I would then turn to paragraph 289, but I will wait until your indication that you're fine if I can move on.
I have read it, yes.
Okay, so let's go to paragraph 289.
I'm sorry, was there, I don't think there was was there a question on 238?
It will come after my next paragraph. So I refer you to paragraph 289, where the Régie indicates that in its view, the CAPM remains the most appropriate base model to guide the determination of a reasonable rate of return. So based on paragraph 238 and 289, would you agree with me that as for these extracts, the Régie in this decision, and of course in previous decisions, as it is stated, has primarily applied the CAPM method?
I will agree with you that in 2009, the Régie decided to rely primarily on the capital asset pricing model. It's also true that that is more than 10 years ago, and Canadian regulation has changed since then. For example, the British Columbia Utilities Commission has applied both the DCF and the capital asset pricing model, as has the Alberta Utilities Commission.
What was the first one you mentioned?
British Columbia Utilities Commission and the Alberta Utilities Commission. As for others, I don't know.
And that was, they applied which method, the CAPM and DCF?
The CAPM and the DCF, yes.
Okay. After the Régie's finding in 2009, is it to your knowledge that the Régie has also relied primarily on the CAPM method in 2011?
I believe the Régie primarily relied on that too. And if I may, I believe that the Régie at all times should be presented with the best evidence the experts have to offer and then make a decision from there.
I understand your point, but my question is that, is it to your knowledge that in 2009, the Régie relied still on the CAPM method as a primary method?
The Régie relied primarily on the CAPM method, yes.
Okay. And I'm referring to, if I'm telling you, it's decision D 2011-182. Is it something that that you're familiar with?
I do not recall. I probably have seen it at some point in time.
Just for the reference purposes and for the stenographic notes, I refer to paragraph 205 of that decision and paragraph 242 of that decision.
If I may, Maître Hamelin, instead of just giving the number of 2011-something, maybe if you could tell her what the topic of the decision was, maybe it would help her recall if she's seen it or not. Because I personally don't remember by heart all the 2011 something.
Okay, it's a rate of return decision pertaining to Énergir.
I believe I've seen that decision, yes.
Okay.
But I don't remember the details.
Okay. Would you know if, for instance, Intragaz in previous decision, for Intragaz in previous decision, the Régie has also relied primarily on the CAPM method?
It's my understanding that she has relied primarily on the CAPM in all of its prior decisions, yes.
And just as a reference for information, this Intragaz decision is dated in 2013. And is it to your knowledge that the Régie has also given great weight to the CAPM method in other rate of returns pertaining, let's say, to the electricity HQD, HQT rate of return cases in 2014?
I do not know.
Okay. Let's talk a little bit about DCF-based estimates. As DCF is one method that you use. For the DCF, je vois qu'il est quand même 2h30 aussi. Monsieur le Président, je peux continuer.
Est-ce que votre ligne de questions est longue ou combien de temps vous pensez en?
J'en ai sûrement pour une demi-heure avec cette ligne de questions-là.
Bon. Alors, on va prendre une pause tout de suite pour 15 minutes.
Parfait.
Merci. Alors, on se revoit à 14h45. Alors, nous allons poursuivre avec les questions de Maître Hamelin.
So just before the break, I was indicating that I would want to ask you some questions pertaining to the DCF method. You describe in your report the DCF method, and just to put in context, and I'm just reading, essentially paraphrasing what you're saying in your report, that the first step of your analysis is to examine a sample of investment analysts' forecasted earnings growth rates for companies in your samples. So I just referred to so everybody knows that we are going to talk about investment analysts' forecasted earnings growth. I understand that for both of the DCF method, either the single stage or the multi-stage, you have used analyst forecasts of company specific growth rates that was sourced by either Value Line and Thomson Reuters IBS. I don't know if it's the way to pronounce it. is it fair to say that the forecast come from security analysts that follow the stock?
The IBIS growth forecast comes from security analysts. The value line forecast comes from value line staff.
Okay, so value line from their staff and the IBIS from security analyst.
Yes.
Okay. Have you checked how many analysts actually cover these stocks versus the number of analysts that provide growth forecasts?
No, I have checked how many analysts provide a forecast. I responded to that in a data request.
And would you agree with me that, let's say, in terms of ratio, if I was going to say that probably 30 analysts would generally cover these stocks, while there would be, let's say, 2 or 3 analysts that would provide the forecast? Would that be a fair ratio?
I don't know. It sounds high because the entities we're talking about are utilities, and they tend to, on average, at least the U.S. gas LDC sample, are probably smaller than the average company that's in the, say, TSX.
Okay. But in terms of the security analysts, to say that there would be a few would be correct?
There will be a few analyst forecasts for each company. I think that data response I responded to is everywhere between 2 and I think 6 for the most is the most we have for any company.
And I understand that most of the companies in the Canadian utility sample are not covered by value line, and that's why you have relied on IBS growth rates for these companies, correct?
That is correct. Most of them are not followed. Some of them are, not all.
Okay. And IBS is an American company?
It is.
Do you know if their analysts are based in the US essentially?
The IBIS forecast they don't provide forecast. They collect forecasts from equity analysts, and they collect forecasts including from Canadian analysts. HBRS, for example, I see comes up in them. Bank of Montreal comes up on some of them.
Okay. I would like you to go to your exhibit BV 4.5. And Madame la greffière, c'est dans les annexes au rapport. So it's a schedule to Dr. Villitsen's report, which is exhibit B15, but the schedule starts, it's a bit difficult or confusing. It's BV3, but then you go to the schedule BV 4.5. And it's at page 4 of BV3.
Maître Hamelin, pourriez-vous nous donner la page PDF de la pièce B15?
J'ai juste le document papier devant moi. Peut-être qu'on peut m'aider.
C'est la page 143 de 215.
I'm there.
Mais je veux m'assurer que la régie le soit aussi. Okay. Parfait. So in this page, we see the estimates So the estimated growth rates for the Canadian sample. And in the second column, we see the number of estimates. And especially with respect to EBS, we see that the numbers go for estimates from 2 to 4 at the maximum. Am I summarizing it correctly, Dr. Willitson?
Yes.
Okay. If a utility analyst provides a growth forecast for a company they cover, in your judgment, are they likely to provide a forecast for all the utilities they cover?
No, not necessarily.
Is it possible that with the 5 of the 8 Canadians where we only have 2 forecasts, that it's really a low number of analysts that would follow those companies?
I don't know. The other thing to keep in mind here is that the way IBIS does their forecast is that if any one forecast is more than 180 days old, they no longer use that forecast. They consider it outdated. So it's possible that more analysts have provided forecasts, but those are outdated as of this time.
So you explained the low number of estimates, not by, am I to understand, not by the fact that there are a few security analysts, but by the fact that some estimates would be outdated? Is that what I should understand?
I don't know, but it's one other explanation for why there might be fewer.
But one of the reasons could be the number of analysts, correct?
Yes.
Okay. And I see that for value line, because they do not necessarily cover the jurisdiction, we only have 2 estimates.
That's correct.
Okay. Would you agree with me that it's a small representation for the sample?
I would agree that it would be preferable to have more analysts covering, but I still believe that this is information that is provided by very large, mostly institutional investors, and I believe they probably do have value and investors look at this.
I understand from your answer that it could be better.
It's always better to have more data in terms of this issue, yes, but it doesn't mean we should dismiss the data we do have.
Would it be fair to say that most of these estimates would be given by U.S. agencies?
I don't know. I would have to go back and look at my response to where the analyst came from. It's also important here to actually realize that with the exception of 2 companies in this sample we're looking at here, the rest of them have more assets in the US than they have in Canada. So it's really a North American sample rather than a Canadian sample, which means that it's not unnatural for US analysts to provide forecast for them.
Okay. I turn back to your report. This time it's in schedule BV1, page 4. If somebody could give me the PDF. And sorry, during the break, I left my computer in my office. So, so I was referring to schedule 1 of your report, which is BV1. and the paper page is page 4. So apologies to the régie.
Oui, alors si
Mais
quelqu'un
Duquette,
pouvait nous donner la page PDF.
je pensais que vous alliez me la donner, alors je me disais...
Non. Ça serait la page 110, me dit-on.
Okay. Alors, it's just under section 2. And I think that you referred briefly to that in your presentation today. It's the question of the optimism bias. Dr. Booth refers to these the securities analysts as a sell side analyst, but in your report, you indicate your position on optimism bias. At the end of this paragraph, when you say and I'm trying to and perhaps we can just scroll down. Yes, yes, here. You referred to academic studies, and at the end, you say none of which is applicable to most utilities companies with wide analyst coverage and information transparency.
Yes.
Would you agree with me that when you refer here to analyst coverage, you mean security analysts for this case?
Yes.
And would you agree with me that the few analysts that we have talked about could be, well, would not necessarily be wide coverage? You agree?
So wide coverage is a relative term because if you look at, for example, the S&P 500, you have an average of 2 analysts covering the 500 largest, each of the 500 largest companies in the US. So here we looked at something between 2 and 4. That's relatively wide.
It's a question of perspective.
Yes.
Do you agree with me that the growth rates forecast you use are short term?
They are 3 to 5 years.
And do you qualify this as short term?
It depends on the perspective. It's short term in terms of the life of a utilities assets. It's long term from an accounting perspective.
And my understanding, is it fair to say that the model generally requires the forecast growth rates that reflect investors' expectations about the pattern of dividend growth for the companies should be a sufficient long horizon?
It requires a forecast for the cash flows for a sufficiently long horizon, ideally for as long as the company exists.
Do you know the names of the investment banks that provides these growth forecasts?
I provided that in a response to one of the data requests.
Perfect.
I think from the receipt, I can't recall as I sit here.
Is it possible for you to verify and provide us with the information?
Yes.
Sorry if I don't have it at hand. We can.
Do you want us to verify now?
No, I think we have. I'm just taking a note for the decision and for the IRs. And you do not remember by heart which Canadian banks?
No, I do not.
Okay. Is it to your knowledge that the Régie has considered in the past the question of the optimistic bias?
I do not recall.
I think I've tried to file during the break the decision which I was going to refer you to, which is decision D 2014-34. I don't know if it's already 78, so it's CSIG 78. If I can ask Madame la greffière to put it on the screen. And just as a little bit of context, if I remember correctly, this was in a rate of return file with respect to Hydro-Québec. Yes. So I'm referring you to paragraph 182, and I will explain to you what I'm looking at. So there was a debate, Dr. Villitson, as to the similar question that you are, the similar question of optimism bias in that decision. And I want to draw your attention to paragraph 184, where the utility essentially referred to an authority to suggest that we should put aside this question of optimism bias. And I refer you to the Financial Analyst Journal. My understanding it's the same article that you are referring in your report. Is it correct?
Yes.
Okay. So that was not, you were not aware of that decision? Dr. Villitson?
I have not seen this decision, no.
Okay.
And as I think has been indicated before, I do not read French.
Yeah, I know, I understand. But sometimes you may discuss with colleagues, so and in preparation of this file, so that's the reason why I've asked you. So it's the evidence that was filed by Concentric in that file. It was not, I understand, to your knowledge either, and they represented the Hydro-Québec.
I did not review Concentric's filing in that docket, no.
Okay. And in that case, it was Dr. Booth testifying for one of the intervener, and he refers to two references to contradict the position that Concentric was taking. I now refer you to paragraph 188 and 189. If we can just scroll down. So Dr. Booth was referring in that decision to I don't know if I can say a study, but a authority from Easton and Summers and also another authority from the firm McKinsey and Company, which was published in the Globe or where there was an article published in the Globe and Mail. Were you aware of those authorities?
I know of the Easton and Summers paper, which is a general study of companies that are in the S&P 500 and not pertaining to utilities specifically. It's also a fairly old article, so they study what might have happened. I can't remember when it was published, but it's not an article that dates back the last 5 years or so.
But I understand that the article that you are yourself citing is dated back 2010, correct?
Yes, the Havakimian article is back to 2010, yes.
Okay. And the other one from McKinsey and Company, was it to your knowledge?
The McKinsey article, no, I have not seen that.
So, and in your own report, I understand that you have cited, I think, 4 articles that was essentially on the same side as the position that was taken by, in this case, by Dr. Booth. So there are, in addition to your articles, there are those 2 articles also raising the issue of optimism bias, correct?
They do. Of importance here is that we need to look at whether or not articles that pertain to the TSX companies or to companies in general have any bearing on utilities. And that was what I was looking for when I was looking for articles for my report. I was looking for what are the characteristics of utilities as opposed to, say, the S&P 500 or the TSX. Utilities are much more stable companies. They tend to be much older. They tend to be, and that's an important aspect of what you actually brought me to before, namely that they have informational transparency, because not only are they regulated by the SEC and similar agencies, but there's also a lot of information in the regulatory environment, such as at the WSHI, where they have to do filings. So there's a lot of information for analysts to look at for utilities that are not available in general.
So we'll go down to paragraph 206 just to indicate the Régie's findings. On that question, they essentially indicate that there was the position of Concentric, there was the position of Dr. Booth, and indicated that there must be prudence using those estimates in the model. So I understand that you were not aware of the Régie's decision indicated that there should be prudence in using those estimates, correct?
I was not, but I do agree that you certainly have to use prudence when you look at these estimates. And that's one of the reasons that I always look to what are those estimates, and one of the reasons that I look also to the multi-stage DCF.
Mr. President, if that would be a good time to call it the day, this would probably give me the time to make sure that I can speak with our expert and be ready as much as possible for tomorrow morning, the continuation of my cross-examination.
Oui, si vous avez terminé, oui, effectivement, ce serait un très bon moment là, pour terminer la journée. Et on se revoit donc demain matin à 9 h.
Parfait.
Alors, merci à tous.
Merci, bonne soirée.
Merci beaucoup, bonne soirée.
Bonne soirée.